Hello friends, I hope I'm visible to all of you and the screen is also visible to all of you. Okay, so I'm getting your response from the chat box. So if there is any query, keep on typing through the chat box so that I will be able to see and I will be able to revert to you. So let's start this session. So very good afternoon to all of you guys. Just to introduce myself, I'm Amit Jain. Um, Today we have a session on business combination Ind AS 103, right? So before starting this session, I just give you a brief background about Ind AS 103 or in respect of the business combination. So business combination, when we are reading business combination, something comes to our mind. That means a combination of the business. So combination of the business can be that I am acquiring a stake in one company. For example, a company has acquiring a stake of let's say 80% in company B. That is an acquisition. Let's say one company is merging into the another company. That is a merger. Let's say there are demerger. One company is demerging one of its business. Let's say the company A is having a multiple business, five business, for example, manufacturing business, telecom business, other business, and and the same company is demerging its business and transferring it to one of the another company. That means it is called a demerger. So when we talk about business combination, when we are reading business combination, there can be the multiple scenario of business combination, right? So in respect of business combination, today we are going to understand how to do the accounting in case of amalgamation, how to do the accounting in case of merger, how to do the accounting in case of demerger and all those stuff. So we have Ind AS 103. Under IFRS, which is issued by ISB, International Accounting Standard Board, we have the parallel standard called IFRS 3, which deals with the business combination accounting. Right, under US GAAP, we also have the same standard or a similar standard called ASC 805. ASC is asset standard codification, right? So under ASC we have 805 under US GAAP. Similarly, we have Ind AS 103 under Indian scenario, right? If I compare Ind AS 103 from IFRS 3, they are largely aligned, barring couple of very few differences. We will talk about what are those differences, right? Under IFRS 3 is applicable in 2009. But in India, we have made Ind AS 103 applicable from 1st April 2015 for the phase one companies. So when we talk about all Ind AS, I'm not talking about only Ind AS 113. I'm now talking about in respect of all Ind AS. When we talk about all Ind AS, when we read all Ind AS, so there are a couple of thumb rule we should keep in mind. What are those thumb rule? That all standards are based on fair value concept. What is the fair value? That means if I am applying any standard, if I am recording any asset, if I am recording any liability, that asset and liability needs to be recognized on fair value on the day one itself, right? So that is the premise of all IFRS. That is the premise. Okay. So that is the premise of all IFRS, and that is also a premise of Ind AS. This is the first thumb rule. When you are reading Ind AS, keep in mind all Ind AS are based on fair value concept. Second thumb rule is retrospective application. So whenever you are applying any standard, that standard needs to be applied retrospectively. Now here we need to understand what is the meaning of retrospective application. So let's say there is a company A Limited who is going to apply Ind AS for the first time as on 31st March 2020. That means company is going to report Ind AS financial statement for 31st March 2020. That means the transition date of that company is 1st April 2018, right? Let's say the company has done several business combination in 2010, 2011, 2012, 2013, right? Now I am sitting at 1st April 2018 and I am applying all the Ind AS on the transition date as on 1st April 18. Now what I need to do? I need to go retrospectively. That means I need to go in the respective years 2010, 2011, 2012, 2013 and so on. And I need to apply this standard on the retrospective date. If I talk about financial instrument, I need to go if there is any transaction in 2010. For example, I have given a security deposit which is refundable after 20 years, right? So that security deposit is outstanding as on 1st April 2018, right? So what I need to do? I need to go in 2010, apply the financial instrument standard on that particular day and bring the carrying value as on 1st April 2018 and record it. Similarly, if I am applying a business combination standard as on 1st April 18, I need to apply that standard from a retrospective date. That means from 1st April in 2010 when I have acquired any business, in 2011 when I have acquired any business, right? And I need to bring the carrying value of those acquisition as on 1st April 18 and record it. So that is the meaning of retrospective application. All the Ind AS are based on the retrospective application. Plus, when we are reading any Ind AS, we should also read Ind AS 101. Why Ind AS 101? Ind AS 101 is a very, very critical standard because any standard is incomplete without Ind AS 101. The reason is the standard is applicable retrospectively, but there are certain exemption and exceptions which are provided in Ind AS 101. That means you are not supposed to go backward from 1st April 18. You are not supposed to go backward beyond 1st April 2018. You need to record certain assets and liabilities as on 1st April 2018 itself, right? So Ind AS 101 helps us in order to avoid the past year accounting, and all the standards are applicable retrospectively. So in order to conclude very quickly, two thumb rules: one is fair value concept, second is retrospective application, right? So this is about the brief background about Ind AS 103, right? Applicability under IFRS 2009. From in Ind AS we have 1st April 2015 and all those stuff, right? Now, before moving to or before jumping to Ind AS 103, I think we should devote 5 minutes in order to refresh our knowledge under Indian GAAP. Because my experience, I am applying Ind AS for the last 7 or 8 years, Ind AS or IFRS, right? My personal experience is that we should be clear under Indian GAAP the accounting. If we are clear with the Indian GAAP accounting, then Ind AS accounting is not so complicated, right? So someone has asked, please explain, then shall we go to 2010 acquisition? Okay. So I will come back this question again at the end, but in order to clarify here is, if let's say I'm applying Ind AS for the first time as on 1st April 18 as a transition date, I am supposed to go in the past in 2010 and apply the standard in 2010 itself and bring the carrying value of those acquisition. Acquisition means the assets and liabilities which I've acquired in 2010. I need to bring the carrying value of those assets and liability in 2018. And as on 1st April 2018, I need to record those assets and liabilities. But they, so if you look at, there are so complications in order to go in the past and record all these accounting. So Ind AS 101 comes into the picture, and Ind AS 101 says that it's a management option. If they want to go in the past, they can go. If they want to avoid, they can avoid those retrospective application. They will record as of 1st April 2018 all the assets and liabilities which in coming as per the previous gap. So so that is why I'm saying we need to evaluate the standard along with Ind AS 101 exemptions, right? So I'm moving to Indian GAAP. Let's devote 5 minutes on Indian GAAP. What is given under Indian GAAP on account of business combination? So if we look at Indian GAAP, there is one standard which talks about amalgamation, right? AS14 of Indian GAAP is basically talks about Indian GAAP accounting on the amalgamation. So this standard amalgamation is only in respect of amalgamation of one company or a two company or a combination of one or more company. Amalgamation in the nature of purchase, amalgamation in the nature of merger. But this standard AS14 does not talk about the acquisition. Means if I have acquired 80% stake in company B, right, this standard is not applicable. So under Indian GAAP, which standard is applicable in that case? There is no standard under Indian GAAP in that case. Then we have to apply the normal accounting principles, right? So amalgamation AS14 only talks about amalgamation in the nature of merger and amalgamation in the nature of purchase. So if I look at purchase method gives me an option that whatever assets and liabilities which I'm acquiring, those assets and liabilities needs to be recorded either at the book value or the fair value. And if there is any difference between the purchase consideration and the net asset acquired, that difference is to be recognized either as a goodwill or capital reserve. If the purchase consideration is, let's say, 100 rupees and I have acquired a net asset of rupees 80, then the difference of 20 rupees will be recognized as goodwill. And if there is a vice versa case and a negative number is coming, then that negative number is recognized as a capital reserve. Right, guys? And in the nature of merger, as per AS 14, it says that I need to recognize all assets and liabilities as per book value. And if there is any difference, that difference needs to be recognized in the capital reserve. So I need to borrow the small concept of how to recognize goodwill under Indian GAAP to Ind AS. So it clearly says, how should I record a capital reserve? How should I record a goodwill? So it says purchase consideration minus net asset acquired is equal to either a goodwill or a capital reserve. So factually speaking, guys, if you understand this basic concept, which we have read a way back in our past, entire business combination is revolving around only this small concept: purchase consideration minus net asset acquired either at book value or fair value. That is a different matter. But purchase consideration minus net asset acquired is equal to goodwill or capital reserve. Entire business combination is revolving around this small formula. Right, we will use this formula in the entire business combination. We will use this formula into understanding the basic concept of the business combination. Right, guys? So I'm moving ahead. What else is given under Indian GAAP? Indian GAAP also talks about goodwill. AS 14 talks about goodwill. AS 10 also talks about goodwill. AS 10, old AS 10 says that the goodwill needs to be written off over a period. What is a goodwill? It says when I'm acquiring a business and the purchase consideration is more than the net asset, then the difference will be recognized as a goodwill, and that goodwill is to be written off over a period. So AS 10 deals with the fixed assets, old AS 10, but it provides the concept of goodwill, and it says goodwill needs to be written off over a period. AS 14 also provides a goodwill concept, and it says the goodwill needs to be written off over a period of 5 years. That means it will be amortized in the P&L over a period of 5 years. Consolidation related standards. What are the consolidated related standards under Indian GAAP? AS 21, AS 23, and AS 27. AS 21 deals with the subsidiary accounting, AS 23 deals with the associate accounting, and AS 27 deals with the joint venture accounting. All these standards are silent on the amortization of goodwill, but there is a background material issued by ICI way back on AS 21, and it says goodwill is not to be amortized. Goodwill needs to be tested for impairment. Right? So that means there are the three types of goodwill. One goodwill which is arising because of old AS 10, that needs to be written off over a period. One goodwill which is arising because of AS 14, that needs to be amortized over the period of 5 years. And one goodwill which is arising because of AS 21, 23, and 27, that goodwill needs to be tested for impairment and shall not be amortized. Right? Another goodwill we are having as per AS 26. AS 26 says that the self-generated goodwill cannot be capitalized. Right, guys? So here we have the concept of amalgamation under Indian GAAP. We have the concept of goodwill impairment or goodwill amortization under Indian GAAP. What else under Indian GAAP? Indian GAAP tells us about the accounting of subsidiary. Indian GAAP also tells us the accounting of associate. Indian GAAP also tells us the accounting of joint venture. Let's see. Subsidiary accounting. Indian GAAP says in respect of the subsidiary accounting, I need to do the line by line consolidation. Suppose I have acquired 80% stake in company B. I'm a company, I have acquired 80% stake in company B, right? But this company B has become a subsidiary to me because I'm having a stake more than 50%, right? Now I need to do a subsidiary accounting. So standard AS 21 says I need to do line by line consolidation. Now the question is, what is line by line consolidation, or what is 100% consolidation? It means that irrespective of the stake I'm having over that subsidiary, I need to console that subsidiary on a 100% basis. It means I need to console that subsidiary in my console financial statement 100%. That means I need to combine 100% assets, I need to combine 100% of liabilities, I need to combine 100% of revenue, and I need to combine 100% of the expenses. So in a nutshell, I have combined the 100% of the financial statement, assets, liabilities, revenue, and expenses of that subsidiary into my company in my console books. But actually I have acquired only 80%. I am not the owner of 20%. So what should I do? I should recognize 20% as a minority interest. 20% as minority interest. This minority interest under Ind AS is called NCI, non-controlling interest. Non-controlling interest means that if I am a holding company, I am having a control. So 20% stake is held by those companies which does not have the control over the company. That is why it's called non-controlling interest. So under Indian GAAP, we have to do line by line consolidation in case of subsidiary. Under Ind AS, we have to do line by line consolidation under Ind AS as well. And we need to record non-controlling interest. Under Indian GAAP, we record the non-controlling interest, but in the name of minority interest. Correct, guys? What else? Associate accounting. Associate accounting, how under Indian GAAP should I account for the associate accounting? It's very simple. I need to do the equity method accounting, right? Suppose I am holding a stake of 25% in a company, right? Associate means a significant influence, which is generally developed if I'm acquiring a interest either from 20% to 50%. If I'm having an interest more than 50%, it is a subsidiary, but 20 to 50%, it is a associate, and below 20%, it is considered to be a passive interest, right? No significant influence. So if I'm having a 20%, 25% interest in my one of the company, that is called an associate accounting. What should I do in case of the associate accounting? I just need to record the investment first on the date of acquisition in my standalone books, and in the consolidation books, I need to do the equity pickup. So whatever the profit he is earning, whatever the profit that associate is earning, I just need to compute the 20% of that profit and add into my investment as well as into the P&L. So entry would be investment debit to income from share of profit in P&L, or if there is any loss, this entry will get reversed. So equity accounting is a very simple accounting. Under Ind AS, we have the same method of accounting in respect of associate. What else? Joint venture accounting. In case of joint venture, we need to do the proportionate accounting. For example, there are two companies A and B. They have entered into a joint venture and they have opened AB Limited, right? A has an interest 60% and B has an interest of 40%, but this is considered to be a joint venture. So what should A do? A just need to do the proportionate consolidation. Proportionate consolidation means that A has to acquire 60% of the assets for the console perspective. A has to acquire 60% of liabilities. A has to acquire 60% of the revenue. A has to acquire 60% of the expenses and club it in its console financial statement. That means A has only taken its 60% stake instead of 100% stake in subsidiary accounting. So in this case, there will be no non-controlling interest. There will be no minority interest in case of JV accounting, right? And what we need to do in respect of Ind AS accounting, we need to follow equity method accounting. That means there is a gap difference in the JV accounting from Indian GAAP to Ind AS, right? So if I conclude about Indian GAAP accounting in respect of the business combination, AS14, AS14 talks about merger and purchase, right? Goodwill. AS10 also talks about goodwill. Goodwill needs to be amortized over the period. AS14 talks about goodwill. Goodwill needs to be amortized over the period of 5 years. AS21, 23, 27 are silent, and background material says goodwill needs to be tested for impairment and not amortized, right? If I look at the subsidiary, associate JV accounting, subsidiary line by line consolidation, associate equity accounting, and JV under Indian GAAP, it's a proportionate consolidation, and under Ind AS, it's a equity method, right? So this is the brief background about Ind AS 103 business combination background and what is the guidance which is given under Indian GAAP. It's actually very relevant. If we are aware of what is the basic accounting given under Indian GAAP, then we will be clear in respect of the Ind AS accounting. So someone has raised a question, sir, can you explain the equity method accounting? So let's say I am explaining again, let's say I've invested 20% in company B, right? So I have invested, let's say on 1st April 2019, and the value is 100 rupees. And I will recognize in my standalone financial statement 100 rupees as an investment. So entry would be investment debit to bank. But when I'm preparing my 31st March 2020 accounts, what should I do? Standalone accounts investment will continue, but from the consolidation perspective, what I need to do, I need to take the equity pickup of my associate. So whatever the profit which the associate has earned during the year, I just need to take the 20% of profit and add to my investment and add to my profit. So that is an equity method accounting. Okay, guys. So this is under Indian GAAP accounting. Now we are moving to actually Ind AS accounting, which is Ind AS 103, right? So we will cover someone. So couple of people are raising question in respect of please explain the earlier slide. So guys, don't worry. I will repeat this again during my session. I will repeat all these Indian GAAP accounting during my session. Don't worry. Let's start Ind AS 103. So agenda, we are going to discuss objective, we are going to discuss overview, we are going to discuss business combination and business, we are going to discuss what is the difference between business combination and asset acquisition. Then we are going to discuss goodwill, how to compute goodwill, we are again going to discuss. Then we will discuss transaction cost accounting, NCI accounting, step acquisition, loss or change in control, common control transaction, interplay with Ind AS 101 and 103, and difference between Indian GAAP and India. So that means we have the long list to move on, right? We have to cover all these things. Okay, guys, what is the objective of Ind AS 103? Very clear. If I'm acquiring any company, if I'm acquiring any business, if I'm merging any business, what should I do? I should know what should be the accounting of the assets I'm acquiring. I should know what should be the accounting of the liability which I'm acquiring. Whether should I adopt the fair value accounting or whether should I adopt a book value accounting? How should I account for goodwill? How should I account for capital reserve? How should I account for non-controlling interest? This is the objective of the standard, right? Scoped out. So there are two things which have been scoped out. One is the formation of joint venture. So if two companies are forming a joint venture, that has been scoped out from Ind AS 103. Why? Because there is a separate standard called Ind AS 111 and IFRS 11, which provides the guidance how to account for the joint venture accounting in the books. And second is asset acquisition. It's a very, very important concept, asset acquisition. So whenever I am doing any acquisition, I need to evaluate whether a particular acquisition is a business acquisition or whether a particular acquisition is not a business acquisition, it is actually an asset acquisition. I give you a perspective. Suppose I have acquired a company ABC Limited and that company only has a land, no process, no output. That company only has a land, and I have acquired, let's say, at 100 crore rupees. So whether I have acquired a company or whether I have paid 100 crore rupees to in order to acquire a land. So that in that case, I will say I have actually acquired a land. In that case, I need to account for that accounting not as per 103, but as per the asset acquisition accounting, which is also given under 103. A small paragraph which is also given under Index 103, but actually it has been scoped out. So it's actually very clear what is business combination in order to determine whether the accounting needs to be carried out as per Ind AS 103 or whether the accounting needs to be carried out as per other applicable standard, right? So that is the objective, guys. So this is the flow chart how the standard is structured. First is the definition. We will talk about business combination and business acquisition method. Acquisition method is nothing but a purchase method of Indian GAAP. Under Indian GAAP, we have an option either to record the asset or liability at fair value or book value. But here we don't have an option. We have to record all assets and liability at fair value. Then we have a subsequent accounting, contingent liability, indemnification, contingent consideration. Then we have the common control transaction, right? Common control transaction. Under Indian GAAP, we have the merger accounting, but now we have a common control. Common control means, let's say there is a holding company, and below that holding company, there are two subsidiaries, subsidiary 1 and subsidiary 2. Subsidiary 1 merges into subsidiary 2 or subsidiary 2 merges with subsidiary 1. So that means before and after the transaction, ultimate control remains with the holding company. So that is called a common control transaction, where the transaction happened between within a group, between the subsidiaries, between the associates, between the JVs, but within a group, right? Then we will talk about the disclosures as well. So this is how the standard is structured. Right. Now, actually, we are going to start the standard now. What is business combination? So standard is defined. What is business combination? Standard says a transaction or event in which acquirer obtains control of one or more of the business is a business combination. So that means any transaction in which the acquirer obtain control. Control means you guys already have read this word control under Ind AS 110. Control means more than 50%. Control means power. Control means return. Control means power, linkage of power over return. right? So that concept which you have already read in India's 110, you need to bring that concept here in order to understand the control, right? But whenever we are having more than 50% stake in any company, it is assumed that I am having a control. What is the different form of business combination? Acquisition of the stake. Suppose I have acquired 80% company A, that is acquisition. Amalgamation, I'm merging, my company is merging into another company, that is amalgamation. Legal merger, when two companies merge into a one company, that is a legal merger. Demerger, that means I am demerging one of my business and I'm selling that business either to my subsidiary or to a third party, that is called a demerger, right? And how the I should obtain that control? How should I obtain control? By paying the purchase consideration. Simple. So entire business combination is moving in respect of purchase consideration minus net asset acquired is equal to goodwill. Focus on these points, focus on this formula only. I will be focusing only on this formula, and you will and I'm assure you that you will understand this standard only by the having of this formula understanding, right? So how should I acquire the control? Control shall be acquired by paying the purchase consideration. Simple, right? How should I pay the purchase consideration? Purchase consideration can be paid in cash. Purchase consideration can be paid in terms of I am transferring any asset. Purchase consideration can be discharged by acquiring any liability. Purchase consideration can be discharged by issuing any equity shares, or consideration can be discharged by the combination of all these items, right? So what is a business combination? Control, transaction or event in which acquirer obtains the control in respect of one or more of the business. Now the question is, what is a business? That means if it is not a business, then business combination is not applicable. I need to go to other standard which provides the guidance how to account for the transaction. Correct? So what is a business? if if I forget about standard, what is a business? Suppose it's a manufacturing concern. What is a business? The business means a company having a raw material, having a process, having an input, and those process and input are capable of generating the output. I hope my voice is clear to you. I'm getting some views for a couple of people that disturbance in the voice. I hope it's clear now. Okay, it's clear now. Okay, guys, now it's clear. Okay, so what is business? So standard says, what is a business? Standard says integrated set of activities which is capable of generating the output is a business basically. So there are three things. One is input, one is process, one is output. What is input? Any economic resource that create or has the ability to create output when one or more of the process has been applied to it. So that means what is an input? Any input. Okay. So any resource which has the ability to create an output when the process has been applied to it, right? So that is an input. What can be the input? What can be the input? The input can be a employees. Input can be the tangible assets like machine. Input can be the intangible asset like a technical know-how, right? So input can be the raw material. So those are the inputs. So standard says in order to classify that a particular acquisition is a business, there must be an input. Second is process. Process. What is a process? Process is a system. It's a management process. It's an operational process. It's a resource management process. It's a rule. It's a protocol. So any process, if there is any process which can convert the input into the output, it becomes a business, right? What is the output? Output is that the company is able to generate revenue. Company is able to generate the dividend. Is able to distribute the dividend. Company is reduce the cost. Economic benefit to the company. Economic benefit to the investors. So that is the output. So standard says input is necessary, process is necessary, but output is not necessary. There must be an input. There must be a process. When those process apply to inputs, they are capable of generating the output. That means think about the startup companies. They have the input, they have the process, they have the employees, they have the assets, but they are not generating the output. Whether those are business? Answer is yes, those are business because they have the input, they have the process, and they are capable of generating the output in the future. right? So startups can be a business. So let's take a couple of examples to understand what is a business or not. Scenario one, development stage enterprise. Scenario one, biotech A acquires outstanding share in biotech B, a startup with a license for a product candidate date. Due to loss of funding, biotech B has no employees. There is no employee in biotech B. A has acquired biotech B with a license, and biotech B has no employees. Neither clinical trial nor development are currently performed. However, biotech B will commence phase one clinical trial. So there is A has acquired B. There is no employees. There is no process. Should the acquisition be accounted as a business combination or an asset acquisition? Let's see the answer. It's not a business. It's not a business actually. It's why it's not a business. Input. Is there any input? Yes, the license is there in the business. Process. There is no process. There is no process. Clinical trial has not been currently performed. Is there any output? Whether there is any process due to which the input will able to generate the output? Answer is no, because there is no process. So in this case, this is not a business combination. In this case, it's not a business combination. Then I need to look at any other standard which provides the guidance how to account for that combination, how to account for that investment. Okay guys, let's take one more example. Biotech A acquires outstanding shares in biotech B with a startup with a license of a product candidate. Phase one clinical tests are currently performed. Now, in this case, clinical tests are performing by three biotech B employees. That means biotech B also having the employees, one of whom founded the biotech B and discovered the product. So whether this is an asset acquisition or a business combination, so this becomes a business. This is a business combination. Why? Because there is an input. License and employees are the input. What is the process? Operational and the management process, right? And what is the output? They are not generating the output, but this process, when applied to the input, they are capable of generating the output. So all the conditions of the business will get satisfied. Hence, this acquisition will be classified as a business combination, and I need to account for this business combination as per Ind AS 103. Let's take one more example of the real estate industry. So someone said any process in near or the distinct future should be ignored and not classified as business. So when I'm acquiring any business, I need to focus on the date I'm acquiring. It doesn't matter whether the company will have the process in the future or not. I need to do the accounting on the date of combination, on the date of acquisition. So I need to focus whether the process input exists on the acquisition date or not. Right. Another example, company A acquires land and a vacant building. No process, no other assets, employees, example lease, other contracts, maintenance, security, all those stuff. Should the acquisition be accounted as a business combination or an asset acquisition? Absolutely. Couple of people have said very clearly this is an asset acquisition because there is an input, land and building, but there is no process. If there is no process, it cannot be classified as business combination. Another example, why I'm focusing on the definition part, because it is absolutely very clear. If the definition is clear, entire standard is based on the definition, because the word business matters everywhere. When you apply that standard practically, this is the first step to check whether the acquisition made by the company is a business or not, right? Company A acquires an operating hotel. Now it's saying operating hotel, that means hotel is operating. The hotel employees, franchisee agreement, inventory, reservation, and all back office support. Should the acquisition be accounted as a business combination or asset acquisition? Right. Couple of people said it will be recognized as a business combination. Why it's a business combination? Because it has an input like franchisee agreement, employees, non-current assets. What is the process? Operational process, resource management process associated with the hotel, and they are capable. They should be capable of generating revenue, irrespective of the fact revenue is generating or not. But in this example, they are. This the question says or the case study says they are operating hotel. That means the revenue generating hotel. So in this case, it will be classified as a it will be classified as a business combination. It's a business actually, right? Okay, guys. So I think I should be clear, or you guys should be clear in respect of business and business combination, right? If it is a business, then I will enter into the standard and apply the accounting principle into that acquisition. If it is not a business, then I need to apply asset acquisition. That will be considered as an asset acquisition. The accounting matters. Let's see what accounting matters. What is the difference between business combination and asset acquisition? So if I talk about asset acquisition, asset acquisition means what? I have not actually acquired a company. I have not actually acquired a stake. I have actually acquired an asset, either asset or a group of assets. Suppose the example which I've quoted earlier, I have paid 100 crore rupees in order to acquire the 100% stake in a company, but that company only has a land, vacant land. That is not a business. Why I have paid 100 crore rupees? I paid 100 crore rupees in order to acquire land, either building or both, right? So acquisition of asset means acquisition of the assets or a group of assets. So we need to understand what is the difference between a business combination and what is the difference between combination and the asset acquisition, right? This is the difference, guys. Initial measurement. If I classified a particular acquisition as a business combination, then I need to record all assets and liabilities which I'm acquiring at fair value. But if I'm saying that is not a business combination, if it's actually a asset acquisition, then whatever amount I need to pay, I need to recognize those amount as a part of my PPE. Then I need to apply Ind AS 16 principles. That becomes my cost. Second, goodwill. If there is any business, then it may possible there will be a goodwill or capital reserve. So under Indian GAAP, if there is a negative goodwill, for example, I'm paying 100 rupees and I'm acquiring net asset worth rupees 80 rupees, 20 rupees is goodwill. Let's say it's a reverse case. I'm paying 80 rupees and I'm acquiring a net asset of rupees 100. Then it's a negative goodwill kind of thing. It's called capital reserve under Indian GAAP, and under Ind AS, it will be classified as bargain purchase gain. So the nomenclature from Indian GAAP to Ind AS has gone change in respect of the capital reserve. Under Indian GAAP, we say it's a capital reserve. Now under Ind AS, we will say it's bargain purchase gain. Only a change in the nomenclature. Okay, so if it's a business combination, then I need to compute a goodwill or bargain purchase gain. But if it is an asset acquisition, in case of asset, we don't compute any goodwill. Whatever amount I'm paying in order to acquire that asset, that will be classified as a cost of that particular asset. And I will record that asset in my books of accounts, in my balance sheet, right? Very important difference. Goodwill is not to be computed in case of asset acquisition, but in case of business. So something comes to our mind when I'm talking about business. It means goodwill. It means capital reserve. It means bargain purchase gain. Third point, directly attributable transaction cost. If I'm acquiring a business, it may possible that I am incurring certain costs like stamp duty, like acquisition cost, right? So those acquisition costs needs to be charged to P&L, but under asset acquisition, that will become a cost. So if you look at Ind AS 16, what is my cost? Ind AS 16 define what is the cost. Ind AS 16 says five parameters of Ind AS 16: purchase price, taxes, any non-refundable taxes needs to be added, any refundable taxes needs to be deducted, any direct cost, directly attributable cost needs to be capitalized, any dismantling cost needs to be capitalized. So if I am incurring any cost which is a directly attributable cost and it is classified as an asset acquisition as per Ind AS 16, I need to capitalize that cost in the cost of PPE. But if it is a business combination, that cost needs to be charged to P&L, right? Defer tax. Do I need to record a defer tax on the goodwill? Yes, answer is yes. I need to record a defer tax. So we have a separate slide on this point. I will cover this point in a detailed manner subsequently. But in case of asset acquisition, there will be no defer tax. Fair value of net asset exceeds the purchase consideration. If the fair value exceeds the purchase consideration, the gain will be recognized as capital reserve in OCI, or I will say bargain purchase gain. But in case of asset acquisition, there is no gain. Entire cost, whatever I have paid, that will become my cost. So it becomes absolutely important for me to classify or evaluate whether a particular acquisition is a business combination or a particular acquisition is an asset acquisition, because the accounting differs. significantly. If it's an asset acquisition, I need to apply Ind AS 16. If it is a business combination, I need to apply Ind AS 103. Big difference in both the standard, right? So we should be mindful, we should be careful at the time of evaluating a particular transaction in the practical scenario. Okay, guys, let's take one example in order to understand asset acquisition impact and the business combination impact. Very small case study. Let's say entity P acquires 100% of entities V share for 1,000 rupees and incur a transaction cost of 200 rupees. So entity P acquires 100% stake in entity V at rupees 1,000 and incur a cost of rupees 200 rupees. V has no liability. So that means entity P has paid 1,200 rupees basically. 1,000 for the purchase of share and 200 rupees on the transaction cost. The only assets are building A and B. Their book value is 700 and the fair value is coming to be 300 and 600, right? Tax base of the building is 700 and the income tax rate is 20%. So let's understand first from the business combination perspective. If I apply Ind AS 103, what will happen? Let's say it's a business combination accounting. What will happen? So price paid, I have paid 1,000 rupees and I have incurred 200 rupees. So 200 rupees will be charged to P&L because standard says that any transaction cost needs to be charged to P&L, right? So purchase consideration is 1,000 rupees and I have acquired two assets, two building, asset A and asset B. And all those assets, we have learned one thumb rule initially that everything needs to be recognized at fair value under Ind AS. So asset A and asset B will be recognized on the basis of their fair value and not book value. If it would have been Indian GAAP, then I would say it's an accounting policy choice either to account for the book value or fair value. But under Ind AS, I need to account for at fair value only. So fair value is given in the case study 300 for A and 600 for B. That means I have acquired net asset at rupees 900 and I paid the purchase consideration. So what is the goodwill? Same formula. Purchase consideration minus net asset acquired at fair value is equal to my goodwill. 1,000 minus 900 is equal to 100 rupees, which is goodwill, right? If it would have been an asset acquisition, then what will happen? I need to apply Ind AS 16. I am not supposed to apply business combination. Then what will happen? I have paid 1,000 rupees in order to acquire those assets and I have incurred 200 rupees in respect of the transaction cost. So in a nutshell, I have acquired 1,200 rupees. I have incurred 1,200 rupees in order to acquire asset A or asset B. So that 1,200 rupees needs to be allocated on the basis of fair value of A and B, and I will arrive at the proportionate value of asset A 400 and proportionate value of asset B 800 rupees. And I will record these assets only in my balance sheet as a part of my PPE. That means 1,200 rupees. There will be no goodwill, right? So if I compare business combination accounting to the asset acquisition accounting, in business combination, goodwill needs to be computed. In asset acquisition, no goodwill is there. In business combination, assets and liability need to be recorded at fair value. But in case of asset acquisition, whatever amount I have paid, that becomes my cost. Transaction cost in business combination needs to be charged to P&L. And in case of asset acquisition, that will be capitalized as a part of cost only. Right, guys? Any confusion, any doubt till now? I'm happy to answer your doubt. Any doubt, any question? Hope you are understanding from the concept perspective. So defer tax, one person has raised a defer tax query. So defer tax, I will cover separately what should be the accounting treatment of defer tax. Don't worry. In case of asset acquisition, there is no defer tax. But in case of business combination, there will be a defer tax. I will cover separately. I hope you guys are able to understand and correlate what I'm trying to tell you. My only suggestion when you are reading any Ind AS accounting standard, try to link with the Indian GAAP, try to link with your existing knowledge. Everything is linked with Indian GAAP. We just need to read something incremental which has come up. We just need to read or understand something new which has come up under Ind AS. But to my mind, my experience, everything is linked with our Indian GAAP. So 1% is, there is a question, if we buy any company under IBC, then it's a business combination or asset acquisition. The company has only land. So I think you have in your question itself, you have given the answer. If the company has only land, there is no process, then I will say it's a asset acquisition. It's not a business combination, right? So on the date of acquisition, I need to look what all process the company has, what all input the company has, whether there is any output, whether the process is able to generate the output. So those evaluation needs to be taken care of at the time of acquisition. So should we move on, guys? Guys, should we move on? Okay. Now we are going to understand, or we are going to read acquisition method. If you remember, we have talked about two things. One is the acquisition accounting, and second one is the common control accounting. If I compared with Indian GAAP, AS14 talks about two accounting: amalgamation in the nature of purchase and amalgamation in the nature of merger. Under business combination, we have two types of accounting, or two types of method, I would say. One is the acquisition method, which is largely aligned with the purchase method, and second one is the common control transaction. Common control transaction is basically within the group transaction, right? So we are going to read acquisition method accounting, then we will so acquisition method accounting, entire acquisition method accounting is based on one principle: purchase consideration minus net asset acquired is equal to goodwill or capital reserve. And then after that, we will talk about common control transaction, right? So during our discussion or this session, in respect of the acquisition method, we will extend this formula. Purchase consideration minus net asset acquired. We will extend this formula and understand the different concept by the formula itself. Okay. Acquisition accounting. So within the acquisition accounting, what we need to do, we need to understand. So it's a 6-step process. First is, who is the acquirer? We need to understand who is the acquirer. What is the acquisition date? Identify and measure the purchase consideration. Identify and measure the identifiable assets and liabilities. So if you see, this is only talking about that formula: purchase consideration, net assets acquired. Net asset means assets minus liability. Then it is also talking about non-controlling interest, which is minority interest. Then it's talking about goodwill. So that means, if you look at except 1 and 2 point, which is the evaluation category, 3, 4, 5, 6, depending upon a same formula: purchase consideration minus net asset acquired is equal to goodwill or bargain purchase. Correct? Let's start. Who is the acquirer? Who is the acquirer? So standard says the entity that obtains the control of the acquiry is identified as acquirer. Control. Now everywhere the word has been used as control. You have already gone through Ind AS 110, right? So we just borrow the concept of control from Ind AS 110. It says 50% of the voting rights. If I'm having a 50% of the voting rights, more than 50% of the voting rights, then it will be classified as control. That means, for example, I have acquired 60% in company B, right? So it is assumed, or it is presumed, that I am having a control over that company. If I am having a power to appoint and remove the board of director, then it is assumed that I am having a control over that company. Investors have currently exercisable potential voting rights. What is potential voting rights? Potential means in the future. Voting rights means, we all know voting rights. So those voting rights which are arising in the future, what do you mean by that? So suppose I have invested in the convertible debenture. Those convertible debenture will be convertible into the equity shares in future, right? Those convertible debentures will be converted into the equity shares in the future. That means when those will be converted, I will gain the voting rights in future. So those are called the potential voting rights. So in order to evaluate the control, these are the different indicators. I need to evaluate whether I'm having a more than 50% voting rights or not. I need to evaluate whether I have a power to appoint or remove board of directors. I need to evaluate whether I am having a potential voting rights or not. On the basis of that, I will say who is the acquirer. So acquirer is a person, or acquirer is the entity who has the control over another entity. This can be explained through this diagram as well. The person who is standing is having a control over the other person who is bending. It's a control scenario, right? from Ind AS 110, I have taken this slide from Ind AS 110. So 110 talks about what are the different indicators of control, right? IFRS 3 or Ind AS 103 does not talk about the control. It says control needs to be there, but what is control? What are the different indicators of control that is defined under Ind AS 110? So I will briefly touch upon what are the different parameters which is given under Ind AS 110, right? Briefly touch upon. So first point is power over investee, right? So if you look at the second point, if I'm having, how the power can be reflected, how can I say I am having a power over other person? If I'm having a voting rights, then I will say I have a power. If I'm saying the potential voting rights, convertible instrument, debenture, bonds, then I will say I have a power over other person. If I have a right to appoint key managerial person, if I have a decision making rights in the company, if I am having a kick off rights, removal right, kick out rights, then I will say I have a power over other company. Return, if I'm having an exposure to the return, for example, dividend, remuneration, synergies, economies of scale, and with the help of this power, I can change, or I have the ability to use the power to affect the investor return, then I will say that I am having a control, right? So whenever in the practical scenario, you have to evaluate whether the acquisition is there or not, whether I am having a control or not. You need to apply Ind AS 103 as well as Ind AS 110 in order to evaluate whether I am having a control or not. Okay, someone said what is the protective right? So protective right means, suppose I am having a control on a company, I have acquired, let's say, 80% in company B, right? I have acquired 80% in company B, but there are certain parameters that, for example, the company A, which is the holding company, company A can give its approval on the capital budget, right, exceeding 10 lakh rupees, right? So those are the protective rights which is given for the company. It will not impact the powers. For example, the company is saying that a particular operation needs to be carried on in a particular manner. That is a protective right which is available to the particular organization, right? Suppose I'm having 80% in company B, and company B has a power that they can approve the budget, approve the capital expenditure up to 15 lakh rupees, up to 10 lakh rupees. So that is a protective right available to the company B. So company can design a particular manner that they can hire the employee having a salary of, let's say, 1 lakh rupees per month up to 100 employees. That is a protective right which is available to the subsidiary. So those protective rights are given in order to carry on the business, in order to operating the business on a day-to-day basis, right? So those protective right will not impact my control. The control which I'm having, it will not impact. So those are called the protective rights. Okay, guys. So acquirer, we have talked about acquirer. Who is having a control is the acquirer, right? So 50% or more is an indicator. Potential voting rights, it's an indicator. And the kick-off rights, removal or appointment of the board of directors, these are the indicators. But there can be a certain scenario where it will be difficult to identify who is a acquirer, right? So standard provides further guidance. It says if the business combination has been affected by transferring a cash or other assets, or by incurring a liability, then who is the acquirer? So it's saying if the business combination or if the acquisition is made in which the purchase consideration is to be discharged through cash, or through transferring an asset, or through acquiring or assuming a liability, then who is the acquirer? It says the person or the company who is transferring cash, who is transferring the asset, who is assuming the liability, is the acquirer. It's absolutely very general. The person who is transferring the purchase consideration is the acquirer. This is what is written under Ind AS 103. Second scenario, where the business combination has been affected by exchanging the equity interest, where the purchase consideration is to be discharged through equity, then who is the acquirer? The acquirer is usually the entity that issues its equity interest. So suppose I have acquired 80% stake in company B, right? And instead of paying the consideration in cash, I am issuing the shares. I am issuing the shares. In that case, who is the acquirer? Then I will be the acquirer, because how I am discharging my purchase consideration, the person or the company who is discharging its purchase consideration is considered to be the acquirer, right? Let's take a couple of practical example to understand, or the case study to understand this thing. X and Y are two existing entities carrying on business independently. The two entities decide to combine their business through a new entity Z. New entity Z acquires the equity shares in proportion to 2:1. Right? New entities acquire the shares in the proportion of 2:1 to the equity shareholder of X and Y. Who is the acquirer? Who is the acquirer in this case? Okay, X and Y are two existing entities. I'm repeating again, on a business independently, and two entities decide to combine their business and they form a new entity. They have formed a new entity and the Z has issued the equity shares because they have invested in company Z. Z cannot be the acquirer. Z cannot be the acquirer. So it could, so when the Z has issued the shares 66% to, they have issued the share in the ratio of 2:1. That means X will be the holder of 66% and Y will be the holder of 33%. So who is the acquirer? X will be considered as an acquirer who has obtained the control of over Z. Z, how can Z be the acquirer? Z has not acquired anything. Z is a company who is formed, who has acquired the control. X entity X will be the acquirer because X has obtained the control over Z. So guys, think about that. Think. Okay, in respect of how the X will be the owner. So someone raised question how the X will be the owner. The first concept, who is the acquirer? If I am acquiring 80% stake in company B, I have acquired 80%. Who is the acquirer? Whether company B is the acquirer, whether company A is the acquirer. I will be the acquirer because I have acquired 80% stake. Right? How I will be discharging the purchase consideration is the second scenario. If I have acquired the stake, then I am the acquirer. In this case, the guidance or the fact pattern is not in respect of the purchase consideration. It's simply saying as X has acquired 60% stake and Y has acquired 33% stake in the ratio of 2:1. Who has acquired the control? Entity X has acquired the control. Right? So it's actually become very important in a particular scenario or the practical scenario who is actually an acquirer. Let's take one more case study on this. ABC intends to acquire. Someone raised question, but there is no entity X as only shareholder. No, there are two existing entities. It is written in the case study. There are two companies which are existing. They have formed a new company. So it can be possible. Now, suppose there is a company in US and there is a company in Australia. They have formed a new company in India. It's possible. Company in US will be the holding company. Company in Australia will be holding, let's say, 40%. Right? So company will be the company which is formed in India will be the entity which they have formed through the two parent, I would say. So someone has raised a question how you have computed 66% or 33%. Compute in the ratio of 2:1. Total shareholding is 100. How do you compute? 100 divided by 3 into 2 will be held by X and 100 divided by 3 multiplied by 1 will be held by Y. Simple. 66% and 33%. So ultimate shareholders, who are the shareholders of Z? Shareholders of Z are X and Y in the ratio of 66% holding and 33% holding, right? And who is the acquirer? So, okay, forget about Ind AS 103. Let's talk in a practical scenario under Indian GAAP. X holds 66% in company Z and Y holds 33% in company Z. Who is the acquirer actually? Think from the Indian GAAP perspective. Who is having a control? Forget about Ind AS 103. So even under Indian GAAP, I will say X is considered to be the holding company, right? X will be considered as the holding company and it will be considered as an acquirer in order to do the accounting of Ind AS 103. And in the case of Y, it will become a kind of significant influence because significant influence kind of associate. For Y, Z becomes an associate 20% to 50%. Back to Indian GAAP, guys. On the very first slide, we discussed Indian GAAP. 50% or more than 50% subsidiary accounting, 20% to 50% associate accounting. Why is the, and someone said, why is NCI? Absolutely. Why is the NCI? X needs to do the consolidation, 100% consolidation in its books of account, right? That means X will consolidate 100% assets, 100% liabilities, 100% revenue and expenses, and it will show 40% as a, or it will show 33% as a non-controlling interest. X, Mr. Entity X is not dissolving. It is written in the question. X and Y are two existing entities. These are not these are not liquidating. These are not dissolving. Very simple. Two companies have formed a new company, right, guys? Okay, there are multiple questions on this point. What will happen in case of liquidation? We will capture everything. Don't worry. Let's focus. Let's try to understand what is given in the standard. Let's learn the concept first. Okay, very good case study. ABC intends to acquire a majority stake and control of target company TE. So there is a company called ABC and there is a company called TE, target entity. To give the effect of acquisition, ABC incorporates a new company NL. So ABC has incorporated a new company NL. ABC subscribes equity capital of NL and provides a loan at a commercial rate interest commercial interest rate to NL, right? So ABC has incorporated NL and ABC has acquired the equity shares of NL because ABC is the holding company, and ABC has provided the loan to NL, and these funds will be used in order to acquire the 90% voting shares of T in an arm's length transaction, right? And the group structure is as follows. The question is, who is the acquirer of TE? Who is the, if I'm not talking about NL, I'm not talking about ABC, I'm only talking about who is the acquirer of TE, whether it's ABC or whether it's NL. If we look at the logics, if we look at the guidance, the person or the entity who is transferring a purchase consideration and acquiring a control 50% more, then it is a case of, then it is a case of acquisition. It's not a common control. Common control will happen if NL and TE both would have been the subsidiary of ABC, then it would have been a common control, right? So it's not a common control transaction. So TE a third party, NL is a newly incorporated entity. There is no relationship between NL and TE. There is no relationship between ABC, NL and TE. ABC has developed a new company, and due to, and this new company becomes a subsidiary. Now what has happened? ABC has infused the funds in NL in order to acquire TE. So the question is, who has actually acquired, whether ABC has acquired the TE or NL has acquired the TE? Who is the acquirer? So people has absolutely said NL will be the acquirer. NL will be considered as acquirer as NL has paid cash to give the effect of the business combination. So in this case, ABC has acquired the interest in NL, but ABC has not acquired the direct interest in TE. So from the business combination accounting, I need to do the business combination accounting in the books of NL, who has transferred the fund, who has transferred the purchase consideration. Right, guys? So it is absolutely very critical that we evaluate who is an acquirer in a practical scenario. Right? Let's move on the step number 2. Now the question is, from which date I need to do an accounting? From which date I need to do an accounting? Okay, the standard says, standard gives the guidance in respect of the acquisition date. What is an acquisition date? It is the date on which acquirer obtains a control. So it says the date when the acquirer obtains a control, I need to do an accounting, right? I need to do an accounting from which date? In on the date on which I have acquired a control. Now there is two concepts of date. One is the appointed date and second one is the effective date. What is an appointed date? Appointed date is that date in which both the acquirer and acquiree agree that the accounting needs to be taken place from a particular date, right? That is called an appointed date. What is an effective date? Effective date means a date of filing of a court order sanctioning the scheme with the state authorities. What does it mean? There is a section under Companies Act, section 232, right? It says that in case of any merger, so section 32 deals with the merger and amalgamation. So it says if there is any merger and amalgamation, then the company has to file a approval to the court. Earlier it was filed to the high court. Now in the last couple of years the process has been changed and it will be filed to the NCLT, National Company Law Tribunal, right? And which is equivalent to the high court. So let's say I have filed a scheme on 1st April 2019 for the merger of one company into my company, right? And the approval is pending till 31st March 2020, and in, let's say, 30th April 2020, the NCLT has given its approval that they are okay, right? And as per section 232, when I have received the approval from the court, that is on 30th April 2020, within the 30 days from that approval, I need to file that court scheme to the statutory authorities like Ministry of Corporate Affairs, right? So the date of filing the court scheme, which I have received on 30th April, the date of filing the court scheme to the Ministry of Corporate Affairs is considered to be the effective date. That means, suppose I have filed that court scheme on 16th May 2020, then 16th May 2020 will be considered as effective date, right? So coming back to the acquisition date means the date on which I have acquired the control. What is the date what shall be considered the date on which I have acquired the control? It will be, that means the date on which I have filed the scheme to the authority will be considered as the date on which I have acquired the control. That means acquisition date means effective date. Effectively, from which date I have acquired the control? Effectively, I have acquired the control on the date on which I have filed the scheme to the authorities. So under Indian GAAP, I need to, if there is any amalgamation or merger under Indian GAAP, then I need to account for the amalgamation or merger from appointed date itself. But if there is any merger or amalgamation which I am taking care under Ind AS, then I need to do the accounting from effective date. That means the date of filing of court order sanctioning the scheme with the authorities, right? So two dates, acquisition date and appointed date, or instead of acquisition date we can say effective date. So under Ind AS we need to account the business combination from the effective date, which is in the date on which I have acquired a control, the date, and on which date I have acquired a control, the date which I filed the court scheme to the authorities, that will be considered as effective date, right? Okay, one more point in respect of this. Last year in 2019, MC has issued one notification. It's a clarification actually, as per section 232. What is that clarification? The MCA says appointed date identified under the scheme shall also be deemed to be the acquisition date. MCA said appointed date identified under the scheme shall also be deemed to be the acquisition date. So prior to this information or prior to this clarification, we are saying, or we were saying, that under Indian GAAP we need to do an accounting from appointed date, and under Ind AS we need to do the accounting from effective date. But this clarification says appointed date will be deemed, मान लिया जाएगा that appointed date will be considered as acquisition date. That means appointed date will become the effective date for the purpose of accounting under Ind AS 103, right? Initially we were talking about appointed date under Indian GAAP, effective date under Ind AS. MC clarified appointed date will be considered as acquisition date. So now it becomes a complex scenario. What is acquisition date? What is effective date? In which GAAP I need to apply appointed date, and in which GAAP I need to apply effective date? Let's see this slide. So there are two scenarios. One is acquisition of the business where the no court approval is required, right? If I'm acquiring 80% stake in company B, right? In order to acquire the 80% stake, no court approval is required, right? So from which date I need to account for that combination? I need to account for from effective date, which is written under Ind AS 103, right? But let's say there is a one company which is merging into another company. There is one company which is amalgamated into another company in which court approval is required. Then I need to apply the principles of section 232 of Companies Act, as well as the clarification, and it says the appointed date will be considered as effective date. So if I do the combined reading of Ind AS 103 and the MCA clarification and Section 232 of Companies Act, that means where the approval of court is required in case of business acquisition, then I will do the accounting from the appointed date. Where the approval of court is not required, then the accounting will be taken place from the effective date. What is effective date? The date of filing the court scheme to the authorities will be considered to be the effective date, right? So this is the important clarification which has come up in the last year itself. Couple of more points in respect of dates. I'm going backward. MCA clarification. If you read the second point, specific date or an event-based date. So MCA said appointed date needs to be stated in the scheme. So whenever the scheme is filed to the court, the appointed date needs to be mentioned, and that date will be considered as effective date. The date can be the specific date or the event based date. What is the specific date? A specific date can be the 1st April or a calendar date or any date which is suitable for both the companies, or event based date, any condition, if there is any condition associated with that, only on the approval or the clearance of those condition, that will be considered as event based date, right? Third point is calendar date may precede the application date. So suppose I'm filing a court scheme as on 1st April 2019, but I have mentioned the appointed date as on 1st January 2019. MCA said that can also be possible, but the period between the filing and the appointed date cannot be more than 1 year. If that exceeds beyond 1 year, then the justification for the same needs to be given in the scheme, right? So in a nutshell, if there is an acquisition of a business where no court approval is required, I need to do the business combination accounting from effective date. If there is an acquisition of business in which court approval is required, then I need to do the accounting from the appointed date. This is the concept on date of acquisition. Let's take a couple of example in order to understand what is the date of acquisition. So it is a case business combination without a court scheme. So it is the first case where the acquisition is happening, but the approval of court is not required, right? So what is the case study? ABC Limited acquired XYZ. The negotiation has commenced on 1st January 16, and the agreement was finalized on 1st March 2016, right? While ABC Limited obtains the power to control XYZ operation on 1st March 2016. So they are saying negotiation between the two companies have started from January 16, agreement finalized on 1st March 16, and actually ABC Limited has acquired the control over the operations from 1st March 2016, right? The agreement states that the acquisition is effective from 1st January 2016. It is written in the contract that the acquisition will be effective from January 16, and that ABC Limited is entitled to all profit from that date, right? And even the purchase price shall be based on the net asset position on 1st January 16. What should be the acquisition date? Whether it will be the 1st January 2016 or whether it will be the 1st March 2016. So couple of people are saying it should be 1st March 2016, and couple of people are saying 1st January 2016, guys. So if you look at the concept, what we have not read any concept on account of whether the particular asset position purchase price linked to a particular date or not. It is very clearly written in the standard. It is very clearly written in the standard that what is an acquisition date? The date on which I have acquired the control. It's not linked on which date the purchase price needs to be computed. Apply the things which we have read as a concept. Let's see the answer. Notwithstanding that the price is based on the net asset as on 1st January 2016 and XYZ shareholder do not receive any dividend after that, the date of acquisition for the accounting purpose will be 1st March 16. It is only on 1st March 16 and not 1st January 16 that ABC has the power to direct the relevant activities so as to affect the return. So that means it is applying the principles of Ind AS 110. When we have actually acquired the control, we have actually acquired the control which is written in the case study as on 1st March 2016. It's not on 1st January 2016. Right, guys? Let's take one more example on this. So it's a case where the approval is required. If you look at, we have read the MCA circular, it says event based or a calendar based. Now this is the event based. Now we need to understand what is an event. Company ABC Limited and XYZ Limited are the manufacturers of rubber components for a particular type of equipment. ABC Limited makes a bid for XYZ Limited business, and the Competition Commission of India announces that the proposed transaction is to be scrutinized to ensure that the competition laws are not breached. Right? Even though even though the contracts are made subject to the approval of CCI, ABC Limited and XYZ Limited mutually agree the terms of the acquisition and the purchase price before the competition authority clearance is obtained. What is the acquisition date? What will be the acquisition date? Whether the acquisition date can be, is that possible if the acquisition date prior to obtaining the approval of the Competition Commission India approval? Let's see the answer. Since CCI approval is substantive approval for ABC to acquire the control of XYZ limited operation, the date of acquisition cannot be earlier than the date on which approval is obtained from CCI. This is pertinent given that the approval from CCI is considered to be a substantive process, and accordingly acquisition is considered to be completed only on receipt of such approval. That means if there is any approval is attached, I need to obtain an approval for the acquisition for obtaining a control, then the date on which I am acquiring a approval from any authority, that date will be considered as acquisition date. Another question, another case study. Can an acquiring entity account for a business combination based on a signed non-binding letter of intent where the exchange consideration and other conditions are expected to be completed within 2 months? That means they are saying, can a business combination, that means I am acquiring a control, can it be possible that I am acquiring a control based on signed non-binding letter, which is a which the letter or which is not binding anywhere? Can I obtain a control? Answer is no. As per the requirement of the standard, non-binding letter of intent does not effectively transfer the control because I cannot challenge in the court of law. Hence, this cannot be considered as the basis for determining the acquisition date. Any confusion, guy? Any question? So people have absolutely correct. The approval shall be obtained after the CCI approval. That's not binding in the third case. So any question, any doubt as of now, what we have read? So we have read business combination definition, we have read business definition, then we have read the difference between the asset acquisition and the business combination. Accounting will differ, goodwill could be computed in business combination and no goodwill needs to be computed in asset acquisition. Then we are reading purchase method or the acquisition method, in which we have talked about who is the acquirer, in which we have talked about what is the acquisition date, which is a effective date, right? Now the third point is how to compute goodwill. How to compute goodwill, guys? Very nice. So goodwill, what is goodwill? Goodwill, very simple. Indian GAAP, basic 11th class accounting principles. Purchase consideration 100 rupees, net asset acquired 80 rupees, 20 rupees is my goodwill. Okay. So before jumping to this goodwill, I will show you one Excel file in which I have explained a small concept. Are you guys able to see my Excel working file? Okay. Okay, guys. Let's see. A Limited acquires 80% stake in B Limited, right? How should I compute the goodwill? Method 1, which is a 11th class or 12th class formula. Purchase consideration, I have acquired 80%. So I have paid 1 lakh rupees, for example, and I have acquired a net asset, let's say 60,000 rupees. Let's say the fair value of net asset is 60,000 rupees and acquired 80% stake. So what is my goodwill? Goodwill is 40,000 rupees, right? So that is our accounting, or that is a concept of computing goodwill in our earlier times. Now we are computing goodwill in a different fashion today under Ind AS 103, right? Now look at this. I have acquired, I have paid the purchase consideration 1 lakh rupees at 80% stake. In order to acquire 80% stake, I have paid 1 lakh rupees. And I have acquired 80% stake in the net asset. But if you look at, if I've acquired 80% stake, I need to do the I need to do the subsidiary accounting in my consolidation. That means I need to do 100% assets, 100% liability, 100% revenue, 100% expenses, right? And I need to record non-controlling interest. So in this case, what I have tried to achieve in my financial statement, this will be my liability. I will record in my console, this will be my liability. This will be my net asset, which I will record in my console financial statement. And this will be my NCI, which I will record in my console financial statement. And this will be the goodwill. Goodwill in both the scenario will remain the same. It's only a mathematical computation. It's only a mathematical computation. Purchase consideration minus net asset acquired. I am just extending the basic formula which we have read in our school days in our past. I'm just extending the formula. Purchase, now the formula will be purchase consideration minus net asset acquired plus non-controlling interest. And in the same fashion, I will be recognizing the journal entry in my console books. So Prakhar Saxena has raised one point. Sir, please explain the method again. So I'm saying I have acquired a net assets in my. Let's say what should be the journal entry if I prepare my console financial statement. Journal entry will be I have acquired a net asset of 75,000 rupees. I have to pay purchase consideration, which is nothing but a liability, right? What is the amount of the liability? Liability will be 1 lakh rupees, right? I need to record NCI as well. What is the NCI? NCI is my liability, which is negative, right? And I need to recognize a goodwill as well, which is this one, whether my accounting entry is getting tallied, yes or no. So I'm just trying to tell you guys, if I'm acquiring 100%, if I'm acquiring 80% acquisition, if I'm doing 80% acquisition, what will happen? In the console books of accounts, I need to do 100% acquisition and I need to show 20% as my minority interest or non-controlling interest, right? So this is the method of computing goodwill, which is based on our Indian GAAP formula. I'm just extended the formula from Indian GAAP to Ind AS. I hope method 2 will be clear. If there is any confusion, please ask me here, because our subsequent conversation will be dependent on method 2 only. Should I move on? Guys, should I move on? Okay. Coming back to the slides. Okay, guys. Okay, how to compute goodwill? Now this is the comprehensive this is the comprehensive formula which I mentioned here. Entire business combination will be driven through this formula itself, right? Focus here. If I need to explain the business combination in 10 minutes to a person, I can explain the business combination in 10 minutes by this single standalone sheet, by this standalone formula only. So we have talked about purchase consideration, we have talked about net asset acquired, right? And we have talked about non-controlling interest. Now I have added couple of more things. Just a second, guys. uh, um, yes, so I've just minimized the screen in order to so that I can select the particular cell. So we have talked about purchase consideration, right? uh, i'm just uh, I'm just coloring it, right? So we have talked about purchase consideration, we have talked about net assets, right? And we have talked about non-controlling interest, right? I have added four more line items in this formula. One is contingent consideration. Second one is fair value of previously held stake, and then indemnification asset, and then contingent liability, right? After that, I will compute goodwill. So I hope we are clear in respect of purchase consideration. I hope we are clear with the net asset acquired. I hope we are clear with the non-controlling interest. What we just need to read, we just need to read the four items, right? After that, our business combination of acquisition method will be over, right? Okay, let's go one by one. We will understand the purchase consideration again. We will understand the net asset again. We will also understand the non-controlling interest again, because there is something which is given under Ind AS 103 which we have not talked about. But I hope the basic understanding of the formula, if you look at the Excel, I have reduced the net asset in that Excel, right? And I have added the non-controlling interest in that Excel. If you look at this PPT file, I am doing the same, reducing the net asset and adding the non-controlling interest. Okay, guys, I'm moving forward now. Okay, bargain purchase under Indian GAAP, we have said that that if there is a negative goodwill, it will be recognized as a part of the capital reserve. Now under Ind AS, we will say that it is not a capital reserve; it will be recognized as a bargain purchase gain. So there is a difference between IFRS and Ind AS on this point. Under IFRS, this bargain purchase gain will be taken to P&L. But under Ind AS, this bargain purchase gain will be taken to other comprehensive in OCI, other comprehensive income, and from the other comprehensive income, it will be taken to capital reserve and equity. Under Indian GAAP, if there is any capital reserve, where that capital reserve will be parked, it will be parked as a part of the reserve and surplus in the balance sheet directly. It will never be a part of P&L. Similarly, under Ind AS, we have maintained that accounting to recognize the capital reserve or to recognize the bargain purchase gain in my OCI. Okay. Now it's visible to you guys. Someone has raised a point that maximize my PPT. Now it's visible. Mr. Ramanna Murthy. Okay. Okay. So bargain purchase gain, very simple concept. Under Indian GAAP, we take it to capital reserve. Under Ind AS, we will take it to OCI, and through OCI, we will take it to equity or reserves itself. So there is no difference between Indian GAAP accounting and Ind AS accounting. Only the nomenclature has changed from capital reserve. Now we will be saying bargain purchase gain. Okay, guys. So now I will only be talking about 6 parameters which I have shown you, like purchase consideration, like contingent consideration, non-controlling interest, previously held stake, and all those stuff in order to compute the goodwill. Only 6 steps I just need to explain you again, right? So one is purchase consideration. So what is purchase consideration? Standard says, what is purchase consideration? Let's say I've acquired 80% stake in company B. So what can be the purchase consideration? If I'm discharging my liability or purchase consideration in cash, then cash will be the purchase consideration. If I'm transferring or discharging my purchase consideration through asset, then the fair value of the asset will be the purchase consideration. If I'm assuming any liability in order to discharging the purchase consideration, then the fair value of that liability will be the purchase consideration. And if I'm issuing equity interest, then the fair value of that equity will be the purchase consideration. So that means we have read one thumb rule initially, that everything needs to be recognized at fair value. If I need to recognize the purchase consideration, my dear friend, needs to be recognized at fair value only, right? What can be the example of purchase consideration? Cash can be the purchase consideration. Other assets, contingent consideration, very important. Contingent consideration, we will talk about contingent consideration. Contingent consideration is basically a consideration which is dependent upon the occurrence or the non-occurrence of the future event. So I've kept separate slide in on the contingent consideration. We will talk about this. Consideration shall be measured at the acquisition date fair value. So I need to recognize the purchase consideration at fair value, but on which date? On the date I am acquiring control, the date on which I am doing the acquisition, the date which is an effective date, right? Second point, deferred consideration. So what can be the deferred consideration? Standard said deferred consideration shall also form the part of the consideration. So what is deferred consideration? Suppose I've acquired 80% stake in company B at 1,000 rupees, right? And it has been agreed that I will pay 1,000 rupees after 2 years down the line. So what does it mean? I need to record the purchase consideration at fair value. Whether that 1,000 rupees is a fair value today, I need to I need to pay that 1,000 rupees after 2 years down the line. So what is the fair value today? Do I need to do discounting? Answer is yes, because everything under Ind AS and IFRS needs to be recognized at fair value or present value. So let's say the discounted value of that 1,000 rupees over the period of 2 years will come out to be 600 rupees. Then the value of the purchase consideration will be 600 rupees and not 1,000 rupees. That is what the deferred consideration is, where the consideration has been deferred due to the mutual consent and the agreement between the parties. If I have to pay 1,000 rupees after 2 years down the line, I need to compute the fair value on the acquisition date on today, on the date on which I'm doing the accounting. And the, let's say the present value comes out to be 600. So the purchase consideration will become the 600 rupees, right? Then I will recognize that 600 rupees is my liability. And over the period of 2 years, I will accrete interest on that purchase consideration so that it will reach back to 1,000 rupees after 2 years down the line. That is what the deferred consideration is. Okay. Contingent consideration shall also form the part of the consideration. So if you remember the second line item, first is purchase consideration. What we are reading, we are only reading how to compute goodwill. So first step, what is purchase consideration? Purchase consideration needs to be recognized at fair value. Within purchase consideration, deferred tax, if there is any deferred tax, if there is any deferred consideration, I need to recognize deferred consideration at fair value. If there is any contingent consideration, I need to add the contingent consideration at fair value within the purchase consideration, right? And if there is any transaction cost, I need to exclude the transaction cost, because we have read earlier, if there is any transaction cost, that needs to be charged to P&L. That needs to be charged to P&L. So one more point, guys. When we are reading Ind AS 103, that means we are talking about our consolidated financial statement. That means if there is any transaction cost, if there is any transaction cost, that needs to be charged to P&L in the consol financial statement, right? I will cover this topic or the transaction cost separately. Okay. Within the purchase consideration, I have explained you the deferred consideration. I have explained you the purchase consideration. Both need to be recognized at fair value, right? Next point is contingent consideration. What is contingent consideration? Contingent consideration means any consideration which is dependent on the occurrence or the non-occurrence of the future event. Suppose I've acquired 80% stake in company B, and it has been agreed between both the parties that the generation or the output of the machinery which I purchased from company B will generate a particular level in the next 2 years. If that will generate in the next 2 years or achieve at a particular milestone, I will pay you $100 extra, or I will pay you 100 crores extra. I will pay you 100 rupees extra, right? That means it is a case which is, it is a consideration which is dependent on the occurrence or the non-occurrence of a future event. Sometimes it also happens in certain contracts between the parties, that if they say that the EBITDA, the business which I'm acquiring, if the EBITDA of that business, earning before interest tax, if the EBITDA of that business exceeds on a particular target, exceeds, if let's say the EBITDA exceeds 100 crore rupees, then I will pay you 100 crore rupees extra, right? So what is that? That is a contingent consideration which is dependent in a future period. So some of the example which the standard has brought out, what can be the contingent event? These are the example. For example, earning or the revenue exceeds the specified target. EBITDA exceeds a pre-specified target. Approval of a patent or license. If I'm saying it is written as a condition that the patent, that I will get the patent license in the next 6 months down the line, right? I will pay you once the license has been acquired, I will pay you 20 crore rupees extra, 50 crore rupees extra. That will be a contingent consideration. Commencement of the commercial production on a new plant, successful completion of the specified contract negotiation, cash flows arising from the specified asset, continuing as an employee. It can also be a consideration if the employee, if I'm acquiring a business, generally it happens the employee leaves the organization. If there is a particular clause mentioned in the agreement that if the employee continues for the 1 year after the acquisition, then I will pay you 20 crore rupees extra. That is a contingent consideration, right? So what is contingent consideration in a nutshell? It is a consideration which is dependent on the occurrence or the non-occurrence of the future event, right? So some couple of people have raised a point how to arrive at the fair value of contingent consideration, right? So my dear friend, when a combination has been acquired, then we need to involve a valuer, because the valuer has to perform the fair valuation of all the assets and liabilities which I'm acquiring. The valuer has to evaluate whether there is any contingent consideration or not. So in order to compute the fair valuation concept, it's lies in the ball of basically, or the onus of the valuer. It's not we are not the valuer actually. We need to engage a valuer in order to compute the fair valuation of multiple things, right? So in order to acquire a business combination, there are multiple things. We will talk about certain multiple things which we have not talked about till now. So in order to identify, or in order to perform the entire business combination accounting, valuer will be required, right? Okay, someone said if the condition has not been satisfied, what will happen? If the condition has not been satisfied, what will happen? Right. So let's understand what is the accounting treatment of the contingent consideration. As of now, we have understood what is the contingent consideration. Okay. Initial treatment, we have to recognize the contingent consideration. At what value? It shall be the fair value at the acquisition date. What shall be the classification? If I need to pay cash, then it will be a liability. If I need to issue any equity shares kind of thing, then I need to apply the financial instrument standard, whether that instrument which I'm going to issue, whether it's a liability in nature or whether it's an equity in nature, then I need to evaluate as per Ind AS 109 or as per Ind AS 32, right? So in a nutshell, contingent consideration needs to be recognized at fair value, right? Subsequent treatment as per Ind AS 103. uh, if I've classified that equity, if I'm saying that contingent consideration is in equity nature, then that equity will not be subsequently remeasured. If I'm saying that consideration is in the liability nature, then it will be recognized as a part of Ind AS 109. For example, I'm saying that if the employees of the organization will continue for the next 5 years, then I will pay you 50 crore rupees extra after 5 years, right? So what is the fair value of contingent consideration? So let's say the fair value of contingent consideration today comes out to be 40 crore rupees. So I will add 40 crore rupees in my purchase consideration as a part of contingent consideration, right? And so that is a day one accounting, and I keep on adding interest, or I keep on accreting interest on that 40 crore rupees, so that it will reach back to 50 crore rupees after 5 years down the line. So that accounting I need to take care as per Ind AS 109, right? So fair value, what is, so someone said, is the fair value is equal to the present value of contingent consideration? Yes. Yes. So fair value, there are the different methods of computing the fair value. Market value is also fair value. Present value is also fair value, right? Okay. So if I conclude the purchase consideration, if I conclude a purchase consideration, we will take a couple of examples in respect of the deferred consideration as well. If I conclude in respect of the concept for the purchase consideration, so first, purchase consideration needs to be recognized at fair value. If there is any deferred consideration, I need to consider that as a part of purchase consideration at fair value. If there is any contingent consideration, I need to consider the contingent consideration as a part of purchase consideration as well, right? And contingent consideration needs to be recognized at fair value. Okay, guys, let's move on. This is the example which I've quoted in respect of the deferred consideration. So suppose company has to pay. So let's read the example. ABC Limited acquired an equity stake of PQR of 5 crore rupees at 8 crore rupees. That means the purchase consideration is 8 crore rupees and the net asset acquired is 5 crore rupees. ABC Limited ABC Limited paid 2 crore rupees in cash. That means out of 8 crore rupees, they have paid 2 crore rupees in cash, and balance 6 crore rupees has been agreed to be paid by the seller in a 5 years, right? So that means 8 crore rupees is a purchase consideration, out of which I have paid 2 crore rupees upfront. Balance 6 crore rupees is to be paid after 5 years down the line. And the present value of that 6 crore rupees today is 4 crores. So what is the purchase consideration in our case? So purchase consideration in our case will be 2 crores cash which I'm paying plus present value of the deferred consideration which is 4 crores. So that means total purchase consideration in this example will come out to be 6 crores. Concept is very simple. Everything needs to be recognized at fair value or present value. Purchase consideration, deferred consideration, contingent consideration. All three will be considered to be a contingent. All three will be considered to be a purchase consideration at fair value. Right. So this will be the entry. Investment in equity shares 5 crores, goodwill 1 crores, cash 2 crores, and deferred consideration. Right. Now we have the concept of the acquisition related cost. Right, we have read that the in the console books of accounts acquisition related cost will be charged to P&L. It will not be capitalized. But if it is a directly related cost in respect of the asset acquisition, then I need to capitalize that cost as a part of PPE. Right. Now let's understand what is acquisition related cost. Acquisition related cost is an incremental cost. So Anmol has asked what will be the accounting entry, what will be the accounting entry when deferred consideration actually paid. So accounting entry will be very simple. And what today I have classified that 6 crore today I have classified that 4 crore rupees as a part of my liability. Right, over the period of 5 years I will keep on accreting interest, and when the time will come that I need to pay that cash in the future, then I need to debit that liability and credit the bank with the amount of 6 lakh rupees. So that will be the accounting entry of deferred consideration. Absolutely, yes. During the period of 5 years, I will be recognizing the interest cost or as a finance cost. Right? Should we move on? So after this acquisition related cost or transaction cost, we will take 10 minutes break. So if so, someone says Ramanna Murthy is asked, can you give the accounting entry of contingent consideration if the contingent consideration event does not happen and contingent consideration is paid less? So let's say in this case, over the period I have accrued 6 crore rupees, right? After 2 years down the line or after 5 years down the line, it may happen that I have to pay the contingent consideration 4 crore rupees, or it may also possible that contingent consideration becomes I am not supposed to pay any contingent consideration. In that case, it will result in an income, but that income will not be charged to P&L. That will be taken to retained earning. Right, that will not impact my income statement. That will be taken to equity. Okay, someone has raised a question, difference of finance cost will be charged to OCI. So I think there is a problem in respect of understanding the OCI concept. Right, so in OCI we never charge finance cost. Finance cost will be charged to P&L. Try to, okay, let's devote 2 minutes on OCI. So OCI, what is OCI? OCI, the full form is other comprehensive income. But what is OCI? If you look at all the transactions in OCI, those pertains to the some notional accounting entries. So someone has read OCI is not clear at all. Okay. So sir, I am explaining what is OCI again. So OCI contains certain items which doesn't recognize in P&L. Right. Let's understand what are the transaction. So there are the two sides of OCI. One is the items which will be subsequently classified to P&L, and the right side item which will never be subsequently reclassified to P&L. It's all the notional item. It's all the notional item. What are those items? For example, revaluation of PPE and intangible. If I'm revaluing my PPE, the notional gain and loss will be recognized in OCI, not in P&L. Actuarial gain and loss on the defined benefit obligation will be recognized in only OCI. It will not be taken to P&L because it is not a business expenditure. It arises because of the change in the assumption by the actuary. Right. Fair valuation of equity. Change in the fair valuation of equity instrument will be recognized in OCI. This you will read under Ind AS 109 and Ind AS 32. Revaluation of PPE will be taken to OCI. This will you read under Ind AS 16. Actuarial gain and loss on defined benefit obligation will be taken to OCI. This you will read under Ind AS 19. Right? Capital reserve or bargain purchase gain will be recognized in OCI. This you are reading under Ind AS 103, right? These are the items which will be recognized in OCI, and these are the item which will never be reclassified to P&L. These are the right side item. If I talk about the left side item, that means those items which will be reclassified to P&L. Two items pertains to hedge accounting, which you will read under Ind AS 109. Third item pertains to fair valuation of the debt instrument. This you will read under Ind AS 109. Then, if there is any foreign currency translation reserve, that means suppose you are an Indian company, you are an holding in India, and you are a subsidiary in US. So you need to convert that US subsidiary from US dollar into INR, in order to do the consolidation. So while doing the consolidation or while transferring this assets and liabilities, there is a delta rise in the balance sheet. Why the delta will arise? Delta will arise because the assets and liabilities will be converted into the closing rate, and the P&L will be converted at an average rate. So that delta will be classified as a foreign currency translation reserve. That foreign currency translation reserve, if you are following Indian GAAP, that will form a part of the reserve and surplus, and if you are following India, that will form a part of OCI. So these are some of the items which will be recognized in OCI. Finance cost will never be recognized in OCI. It will be a charge to P&L. Right, guys? I hope OCI concept is clear to you in brief. Okay, okay. So acquisition related cost. After this acquisition related, we will take a break of 10 minutes. Then we will come back. Okay, acquisition related cost. It's an incremental cost. What can be the cost? Like legal cost, advisory cost, general administration cost, valuation cost, professional fee cost, consulting cost, finder fee cost, registration cost, stamp duty cost, cost in respect of debt and equity. So these costs will be charged to P&L. It will never be recognized as a part of the purchase consideration, right? For example, stamp duty paid on the acquisition of land to a business combination, whether should be capitalized or it will be considered as a part of business combination. Stamp duty incurred in relation to the land acquired as a part of the business combination transaction are required to be recognized as an expense in the period in which acquisition is completed and given the effect to in the financial statement. So that means any acquisition related cost will be charged to P&L in the consol books. Right, guys? Now we have left with I think 2 or 3 topics within the purchase method, and after that we will talk about common control transaction and difference between Ind AS versus IFRS and Ind AS versus Indian GAAP as well, right? So let's take a short break of 10 minutes and we will come back by 7. Okay. Guys, should we start? So couple of people have raised couple of question in the Q&A session, right? So those are the specific queries or the queries which have been raised during our session. So I will revert to all those queries after this session itself, right? Because we have 1 hour left and we have to cover lots of things. So we will cover all those things. Okay, fine. So now I'm moving ahead. So within the purchase method or the acquisition method, we have covered 2 or 3 things. One is who is the acquirer. Then we have talked about acquisition date, effective date. Then we have talked about how to compute goodwill. Then we have talked about transaction cost. Now we are discussing in respect of the assets and liabilities, right? That means we have talked about purchase consideration. Now we are talking about net assets. As we said earlier, on the acquisition date, we need to account for all assets acquired or liabilities assumed at fair value only, right? Non-controlling interest. Non-controlling interest under IFRS 3 or under Ind AS 103, we have an accounting policy choice that only on the acquisition date I can account for non-controlling interest through fair value method, or I can compute the number on the basis of the proportionate consolidation. Proportionate consolidation basis, I can compute the number of NCI or fair value method. It's a choice given, but that choice is only on the date of acquisition, and subsequently I need to account for the non-controlling interest on the basis of proportionate method, which I follow under Indian GAAP as well, right? And then I will finally compute the goodwill or bargain purchase gain. So the concept here is all assets and liabilities which I am assuming, as well as the NCI which I am assuming, right? Those assets liabilities needs to be recognized at fair value. Now, what has happened when I am done any business combination? When I'm doing any business combination, it is possible that there are certain types of intangible which I doesn't recognize as a part of Ind AS 38 or as a part of AS 26, right? It can be possible. For example, self-generated brand. Self-generated brand is not allowed to be recognized as a intangible. For example, customer list. For example, customer relationship. For example, patented technology. So those kind of information or those kind of assets which I'm having, I'm not supposed to recognize those intangible as per in IS as per Ind AS 38 or as per AS 26, right? So that means what I'm saying is there can be certain intangible which needs to be recognized as a part of business combination, right? Those intangible assets can be of many variety, which is arising because of the contractual nature, which is also arising because of the legal nature. So let's see what can be the basic aspects of what can be the intangible which generally recognize. Trademark, trade names, service marks, collective marks, trade dress, newspaper mastheads, internet domain, non-competition agreements. These are arising because of the contractual in nature. Customer relative intangibles, customer list, that means a data list that needs to be recognized as an intangible. Order or production backlog, the production backlog which the company is having, that can also be recognized as a intangible. Non-contractual order, production backlog, that can also be recognized as a contractual intangible. So the only objective is this: when we are doing the business combination, we need to hire an expert who can do the valuation, right? So that person will identify, that person will evaluate the contract by contract basis what can be the additional identifiable assets in terms of intangible asset, right? So those intangible asset needs to be recognized in the in the console books of the acquirer. So now the recognition of the intangible asset will results in reducing the value of goodwill. If I don't recognize, then the value of the goodwill will be higher. But if I recognize some portion of the goodwill as a part of the intangible, then the value of the goodwill will be lower. So, but the only point is, on the date of acquisition, the company has to recognize those intangible which doesn't exist, which doesn't recognize as a part of Ind AS 38. So Ind AS 103 provides certain guidance. What can be the guidance? So it says the intangible asset is identifiable if it meets the requirement of the separable criteria or contractual criteria. What is separable? That the acquired intangible is capable of being separated from the acquiree and sold and transfer. That is a separable criteria. Contractual criteria: intangible asset arise from the contractual or the legal rights, regardless of whether those rights are transferable or separable from the entity. Those are the intangible condition needs to be met. So customer list, relationship. So I've practically seen, so I've done many business combination accounting. I've practically seen the customer list, customer relationship generally recognized as a part of the intangible, right? Okay, so that means we have read, now what we are doing, we have read the purchase consideration, we have read the deferred consideration, we have read the contingent consideration, we have read the transaction cost. Now we are reading small concept which will which will combine together, and it will complete the acquisition or the purchase method of accounting, right? So this was another concept of intangible. So we have read that all the net asset needs to be recognized at fair value on the acquisition date, and if there is any intangible, we need to recognize that intangible. That is what we have read in terms of new concept. Next concept is the contingent liability. So someone has raised a question, sir, in case of intangible acquired by a company, but which were amortized over a period and whose cost is nil. No, it's not the case actually. So what we are saying, let's say that I have acquired a company at 100 crore rupees, purchase consideration is 100 crore rupees, and the net asset I have acquired, let's say 80 crore rupees. 20 crore rupees is the goodwill, right? But when I have done a purchase price allocation, when I am doing the, what is purchase price allocation, that means I'm allocating every asset, every liability at fair value, right? When I'm doing the purchase price allocation, I have identified that there is an intangible which was not recognized earlier because that was not a requirement. For example, customer list. And I've said, as a valuer, I've said that out of 20 crore rupees of a goodwill, 5 crore rupees pertain to intangible. Then I will recognize, as a acquirer, I will recognize 5 crore rupees as an intangible in my books, and goodwill will be reduced to 15 crore rupees in that case. And this intangible will be amortized over the period, right? So that will be the accounting of the intangible. Now a contingent liability. We have read a concept of contingent consideration. Now there is a new concept of contingent liability. If I talk about contingent consideration, that means occurrence or the non-occurrence of the future event, which is linked to the EBITDA, which is linked with the performance of the asset, which is linked with that the employee will continue over the period. I will pay you extra, right? Similarly, contingent liability. Contingent liability means, suppose I am acquiring a business as on 1st April 2019. Suppose Anmol has raised one question, how we valued customer list or relationship. So again, Anmol, I've said that it is a valuer concept, right? So valuation, the valuer which we appoint, that valuation, that valuer will identify what is the value of those assets and liabilities, including the intangibles, right? So there are the separate principles which have been issued, or separate standard which have been issued by ICI, which talks about the valuation guidance, right? That valuation guidance will provide the guidance how to do, or how to identify the customer list, or how to value the intangibles in that case. So Mr. MM Quatra has asked, should the customer list be recognized separately at fair value as it is internally generated? So customer list is not internally generated. Customer list has been generated as a part of the process of the organization. So that customer list needs to be fair valued, and that customer list as it needs to be fair valued, and that considered to be intangible, and that will be recognized separately from the goodwill. In my example, let's say the goodwill is 20 crore rupees, and I have identified 5 crore rupees additional intangible. Then I will recognize intangible at 5 crores and goodwill at 15 crores. Okay, now I am at the contingent liability. Contingent liabilities, so again it is dependent on the occurrence and the non-occurrence of the future event. What can be the contingent liability? So let's understand what is a contingent liability. Suppose I'm saying I'm a company, and there are the 3 demand outstanding from the income tax authority, 2 demand outstanding with the GST authorities, right? And those demand are in discussion. Litigation is going on, multiple discussion is going on, and those assessment is pending at the different level. So generally those cases will be recognized as a part of the contingent liability as per the requirement of AS 29, or under Ind AS as per the requirement of Ind AS 37. So in that case, we obtain the management assessment whether you are likely to win this demand, whether you are likely to win this assessment, or whether you are likely to lose this assessment. On the basis of that, we assume whether it is a contingent liability or it is a provision. So let's assume it's a contingent liability case. So company, the acquiry has recognized the contingent liability in its books of accounts, right, on account of income tax cases which is pending with the different tribunals, right? And I as a company has acquired that company B as on 1st April 2019. Now the question is whether that liability, whether that contingent liability which is existing in the books of B Limited, should I recognize that contingent liability as a fair value at the time of acquisition? So standard says it may be possible that the company or the acquirer is very clear that the demand will be in the favor of the company, that the assessment or the conclusion is in the favor of the company, but there are the potential risk involved. So what we need to do, the acquirer should involve the valuer and get that fair valuation of the contingent liability on the acquisition date and recognize it. So that means we have the separate line item in my computation of the goodwill, contingent liability. And in that contingent liability needs to be recognized at fair value, right? So that fair value is the initial recognition. And subsequently, what should be the value? I need to amortize. I need to amortize that contingent liability over the period, or I need to assess what will be the value, what will be the fair value on the subsequent reporting date, whichever is higher. I will recognize that number as my contingent liability going forward basis, right? So this will be the accounting treatment of the contingent liability while doing the goodwill computation, right? Let's take an example. ABC Limited is in the process of acquiring PQR, an entity engaged in the business of software related products and services. ठीक है, PQR Limited has been sued for one of the software license it uses in its business. The entity lawyer has advised that, in his opinion, it is probable that the case could be successfully defended. So lawyer is saying case will be um, in the favor of the company only. Accordingly, no provision has been created in the books of PQ or financial statement immediately prior to the acquisition. However, post-acquisition, ABC Limited management had decided that the case should be settled out of the court in order to avoid the protracted court cases, right? So should the acquirer recognize the contingent liability in this case? Right? So as a concept, what we have read, if there is any contingent liability, we need to do the fair valuation. This is a concept we have read as a part of Ind AS 103, right? So what is the answer? Although the case is probable, although the case is probable to be successfully defended, the contingent liability will have a fair value on the assumption that there is some risk that the case may not be successfully defended. To the extent that the fair value can be reliably measured, the contingent liability would be recognized as a part of the business combination accounting. So that means we need to recognize we need to recognize the contingent liability as a part of business combination accounting, right? The concept is very simple. We need to fair value all assets and liabilities which are arising because of the business combination, whether it's a contingent liability or whether it's a normal asset or liability, right? If there is an intangible, we need to identify that intangible and record it at fair value. Okay. Next point is indemnification asset. So indemnification asset is related to the contingent liability itself, right? What is indemnification? Indemnification means to compensate, right? What is to compensate? Let's understand what Ind AS 103 is saying on account of indemnification. The seller in a business combination may be contractually indemnify the acquirer for the outcome of a contingency. The seller in a business combination may be contractually indemnify the acquirer for the outcome of the contingency. That means if there is a contingent liability, let's say the previous topic which we have talked about, contingent liability, it may possible that the contingent liability will arise. I need to recognize at fair value, right? So if there is any possibility in that, then I will also ask the acquiree that he has to compensate to me. If tomorrow any liability arise, so he has to compensate in respect of that liability to me. That is called indemnification asset. I'm reading again. A seller in a business combination, seller means acquiree in a business combination, may contractually indemnify the acquirer for the outcome of a contingency or uncertainty related to all or a part of the specific asset or liability. As a result, the acquirer obtains an indemnification assets. Right. So what I'm saying is, one side I have recognizing a contingent liability which is arising because of the part of business combination. On the other side, it may possible that I will indemnify, I as a acquirer mention a clause in a business combination agreement that the seller has to indemnify me in the future if such liability arise or such liability exists or such outflow of cash is there in the future, right? That is what the indemnification asset is. Let's take an example to understand the indemnification asset. In January 2020, P Limited, Entity P acquires 100% interest in Entity X, a manufacturer of cosmetics. At the time of acquisition, there is an open litigation against S. Litigation: S customers have alleged that S product contain harmful events of parabens that cause the cancer. The claimants are suing S for damages amounting to 50 crore rupees. So when the P company acquiring this company, so there is an allegation, and the case is going on, uh, and which creates a possible cancer to the public, right? And the claimants are suing S for the damages around 50 crore rupees. And it is mentioned in the contract that if there is any liability which will come up, then the acquiree will compensate or indemnify P for the losses up to 50 crore rupees. How should P account for that liability or that asset? What India's 103 says on this: identifiable liability of 15 crore rupees is recognized. That means I will recognize the identifiable liability of 15 crore. What is 15 crores? The fair value of the contingent liability from the litigation on the acquisition date is 15 crore rupees. So I will recognize a contingent liability at 15 crore rupees. The liability is measured at fair value, and the indemnification asset should also be measured at the fair value. Asset is recognized amounting to 15 crores, assuming that none of the possible outcome taken into consideration of the fair value liability exceed the indemnification cap. The only point is, if there is a contingent liability and if there is is an indemnification asset on that contingent liability, I need to recognize both the contingent liability and both the contingent asset. Indemnification asset is nothing but a contingent asset only, right? It may possible that there is a contingent liability which may arise in the future and there is no indemnification of the contingent asset. It may also possible, right? It may also possible that there may be a contingent liability, but the indemnification of the contingent asset will cover a cap at an amount which is lower than the contingent liability. Anything can be happen, right? It is not the case. In this case, contingent liability and indemnification are both same, but it may happen that the amount may vary in the practical scenario. The only point I'm highlighting here is that both the contingent liability and contingent asset in the form of indemnification asset needs to be recognized at fair value on the acquisition date. It is not the case I will net it off and I will not recognize. I need to do a gross accounting. One side I will say contingent liability will be recognized as a part of liability, and contingent asset, which is an indemnification asset, will be recognized as a part of asset in my books of accounts. Uttam has raised one point: is not indemnification asset same as contingent asset? Answer is yes. Indemnification asset is contingent asset only. Should not indemnification asset be deducted from the fair value of underlying contingent liability? That is what I have said. Contingent liability and indemnification asset needs to be recognized on a gross basis. We cannot net it off. We cannot net it off. It may possible the amount of both contingent liability and contingent asset may vary, right? Any other doubt in respect of this? Okay, let's move on. Non-controlling interest. Non-controlling interest is very simple. As I said earlier, non-controlling interest, I have an accounting policy choice either to recognize at fair value or proportionate share. So on the day one, when I'm acquiring a control, I have an option either to recognize at fair value or proportionate share. But on subsequent basis, subsequent reporting or accounting basis, I need to recognize the NCI on the proportionate share basis, as I do under Indian GAAP or as I do under Ind AS. Other topics. So we have largely covered purchase method. I will summarize purchase method once I will cover this topic. Step acquisition. It is a very, very important topic. Step acquisition. What is a step acquisition? Suppose I have acquired a 40% control in company B in 2018, right? In 2019, I have acquired 30% control. So that means I have acquired 30% control. That means I have acquired 70% control in 2019-20. Whether I need to do an accounting as per Ind AS 103 in the year 2018 or in the year 2019. In the year 2018, I have acquired only 40% control. Then I have not acquired the control. In 2018, I am not supposed to do the accounting of business combination. It only an investment. It becomes an associate accounting. But since in 2019, I have acquired additional 30%, which results in a 70% control in that company. That means I have acquired the control. Remember the control definition, more than 50%. The moment I have acquired the control, I need to apply Ind AS 103 accounting in the year in which I have acquired the control. So what is step acquisition? 40% plus 20%, 40% plus 30%. That means from non-controlling movement to a control scenario. That means I am moving one step ahead. If you look at the picture here, the person is jumping on the next stair, right? So that means I'm moving one step ahead. 40% from which is a non-control scenario to a control scenario. Okay. How to do an accounting of the step acquisition? So if I've acquired 40% in 2018, right? So I need to understand what is the accounting I have done in 2018 first, whether I have taken the OCI option or whether I have taken a P&L option, because under Ind AS 109, there are two options. If any equity interest you are holding in the long term perspective, like subsidiary, associate, joint venture, which you are not held for trading, then you have an option either to recognize the change in the fair valuation in OCI or in PNL, right? So if I have taken a OCI option, then change in the fair value of the uh, sorry, okay, okay, step acquisition. So I'm explaining this thing. So I'm explaining step acquisition. So in case of 2018, when I've acquired 40% stake, I will not do the accounting of business combination. But if I've acquired 30% stake, additional stake in 2019, then I will do the accounting of business combination. But on the date of acquisition, what I will do, I will say that on the date of business acquisition, all the assets and liabilities which I'm acquiring, I need to do the fair valuation of those assets and liabilities, right? So on that particular date, my existing stake is already there in that company, which is a 40%, which is a 40% stake, 40% investment I've already made in the previous year, right? So what should I do in respect of that previously held stake? So standard says that that previously held stake, which is an earlier investment, which is a 40% investment in our case, that also needs to be fair valued, that also needs to be fair valued. But how that process will happen, the change in the fair valuation, whether that will go in OCI or whether the change in the fair valuation will go in PNL. So again, we need to look at Ind AS 109. If the option I have taken under Ind AS 109 OCI option, then the change in the fair valuation will be taken to OCI. And if I have taken a PNL option, then change in the fair valuation will be taken to PNL, right? So step acquisition, if I summarize step acquisition, 40% to 70%. That means from non-control to control. Business combination accounting is to be done in the year in which control has been acquired. And on the date of control, I need to apply Ind AS 103 and I need to do the fair valuation of my previously held stake. And the change in the fair valuation of the previously held stake will be routed through OCI if I have taken the Ind AS 109 option, and will be routed through PNL if I have taken the PNL option as per Ind AS 109, right? So this is a small concept of the step acquisition. Now vice versa, it may also possible that if I am holding 80% stake in a company and during the current year I have sold 20% stake, right? It may also possible that I'm holding 80% stake in a company and I have sold 50% stake. So I have reached from 80 to 30% stake. So that change is called either a loss in control or a change in control, right? So what is a loss in control? There are two concepts within this. Loss of control, when I am moving a scenario from a control scenario to a non-control scenario. For example, ABC Limited holds 90% in its subsidiary PQR, but in the current year, ABC Limited sold 60% stake. So from 90 to 30%, it has reached to 30%. That means below 50%. Then it is a case of loss of control. So in that case, what should I do? I need to de-recognize assets and liability. I need to de-recognize goodwill. I need to de-recognize non-NCI because I'm not supposed to recognize the NCI. I'm not a holding company. Recognize the consideration received by selling the 60% stake. I need to recognize the consideration which I have received. I need to recognize the retained investment. That means I need to retain 30% investment. Any gain and loss recognized in OCI earlier needs to be transferred to PNL. So there will be a movement from OCI to PNL, and recognize any gain and loss in associated with the loss of control. So in a nutshell, when I've acquired a control, I need to recognize all assets and liabilities at fair value. I need to recognize goodwill. I need to recognize NCI. When I'm losing control, I need to de-recognize all assets and liabilities. I need to de-recognize goodwill. I need to de-recognize NCI. That means it's a reversal case of the control acquisition, right? I hope this is clear to you guys. Another case, another case where we are saying change in ownership without losing control means change in ownership without losing control. What does it mean? Let's say I am holding 80% control and I have sold off, let's say 30%. That means I am moving from 80% to 50%. Or I would say I am holding 90% or I am selling 20%. That means I am reaching to 70% stake. So still more than 50%. So that is a case where I am still in the control scenario. Control, it is also called control to control. So Ind AS 110 provides a guidance here, change in the parent ownership. So it is changing a parent ownership 90% to 20%, 100% to 80%, 90% to 70%, 100% to 80%, right? So it's a change in parent ownership and which does not result in the losing of control. That will be accounted as a equity transaction. Absolutely. Mr. MM Kotra said it will result in increase in NCI. Sir, it can happen both ways. If I'm reducing from 90 to 70%, NCI will increase. But if I'm jumping from 90% to 95%, then NCI will reduce. It can be both ways, right? Defer tax. Some people have raised the question defer tax. Defer tax, very simple defer tax. The goodwill which we will compute, standard says if that goodwill is a tax deductible goodwill. Tax deductible goodwill means if we claim the amortization of goodwill in our tax, then the defer tax needs to be recognized on that goodwill. If it is a non-tax deductible goodwill, then we cannot create a defer tax on that goodwill. Actually, IFRS 3 is prepared from the global perspective because there are certain jurisdiction in the global which may or may not allow the amortization of the goodwill. I believe from the Indian perspective, people claim the amortization of goodwill in the income tax return. So in that case, it will be a tax deductible goodwill and the company has to recognize a defer tax on the goodwill as well, right? So what will be the accounting of defer tax? What will be the accounting of defer tax on goodwill? So if there is an increase in the fair valuation, then the accounting will be, I need to create a liability. Why the defer tax needs to be created? Because due to the change in the fair valuation of assets and liabilities, right? Let's say the book value of the book value of the net asset which I've acquired is 100 rupees and the fair value is, let's say, 120 rupees. So that means 20 rupees I need to recognize defer tax. Let's see the example. Company A buys company B at rupees 1500. Book value of the asset B 1000 rupees. Fair value is 1200 rupees. That means there is an increase in the fair value by 200 rupees. Goodwill is purchase consideration 1500 minus fair value, which is 1200 rupees, is equal to 300. What is the temporary taxable difference? So difference between the fair value and the book value is the temporary difference. What is the fair value? 1200 rupees. What is the book value? 1000 rupees. And the difference is 200 rupees. And on this 200 rupees, I need to recognize defer tax. So defer tax, let's say the tax rate is 30%. So defer tax liability will come up to 60 rupees. And what will be the accounting entry? Accounting entry will be goodwill debit to defer tax liability. Goodwill debit to defer tax liability. If let's say the fair value declines, it's opposite direction, fair value becomes 800, then it will be a case I will reduce goodwill and I will debit defer tax asset. right? So accounting of deferred tax will be very simple in case of business combination. And the goodwill which I'm recognizing as a part of the deferred tax, that goodwill will also be tested for impairment. That goodwill will also be tested for impairment, right? So that is the small concept of the deferred tax on goodwill. Okay. Next, purchase price allocation. So the entire crux, what we have read in the acquisition method or the purchase method, is the purchase price allocation. What is the purchase price allocation? This is the purchase price allocation to be done by the valuer. So what the valuer will do, valuer has to read the financial statement of the acquiree. He has to identify what is the book value which is given in the financial statement, and on the basis of the book value he has to identify what is the fair value of each assets and liabilities which is a part of the business combination. So let's say in this example there is a 150 delta, the fair value has actually declined in this case, and 5 rupees on account of the contingent liability. So that means change in the fair value and book value is 155 rupees. On this 155 rupees, I need to create a deferred tax asset because there is a decline in the fair valuation, right? So this will result in a creation of deferred tax asset with a reversal of goodwill, right? Or a capital reserve kind of thing. So that is called a purchase price allocation. Okay, common control transaction. So before common control transaction, any doubt in respect of the concepts? So someone said, please explain the entry for deferred tax. Deferred tax entry is very simple. If the fair valuation is increased, so I will say deferred tax liability credit, goodwill will debit. Or if the fair valuation will decline, it will be other way around. I will create a DTA to capital reserve or reversal of goodwill, right? So in a purchase price allocation, in the entire acquisition method, so what we have talked about. We have talked about who is the acquirer, the person who is acquiring the control. I'm just summarizing everything what we have read. Who is the acquirer? The person who is acquiring the control is the acquirer. Effective date, I need to do the accounting from the effective date. Third, uh, third, what we have read, computation of the goodwill. So goodwill needs to be computed. Purchase consideration minus net asset acquired is equal to goodwill or capital reserve, right? Then we have extended the definition or the exam or the formula of the goodwill. Then we have read about purchase consideration needs to be recognized at fair value. Deferred consideration needs to be recognized at fair value. Contingent consideration needs to be recognized at fair value, right? Then we have talked about net asset. All the net assets, that means assets and liabilities acquired, needs to be recognized at fair value. If there is any intangible customer list kind of thing, that we need to recognize intangible at fair value, right? Then we talked about NCI. NCI needs to be recognized at fair value or the proportionate method basis. Then we have talked about contingent liability. Contingent liability needs to be recognized at fair value. Indemnification asset. Indemnification needs to be recognized at fair value. After that, we have talked about step acquisition. That means moving one step ahead, 40 to 60%, 40 to 70%, 30 to 70%, right? So that is a step acquisition. In the step acquisition, what I need to do, I just need to do the fair valuation of my old stake as well. That is the additional input which the step acquisition has provided to us. And the change in the fair valuation will be routed through OCI or PNL depending upon the method which I have taken under Ind AS 109. Right? Then we have talked about deferred tax. Deferred tax needs to be recognized on change in the fair valuation, and the entry will be goodwill to deferred tax or vice versa. Right? Then we have talked about purchase price allocation, which is to be done by the company or the valuer. Right? Purchase price allocation is nothing but the identification of the intangible asset and doing the fair valuation of all assets and liabilities. Okay, guys. I hope these are clear to you. Now I think we should move on to common control transaction, which is as compared to purchase method is very simple, right? So one point in respect of the common control transaction under IFRS 3, common control transaction is not in the scope of IFRS 3, but in India scenario, we have included common control transaction in India's 103 scope, right? Because common control transaction is very common from the Indian perspective. That's why we have included in India's 103. Let's see what common control transaction says. Combination of entities or business in which all of the combining entities or the business are ultimately controlled by the same parties before and after the combination. And the control is not transitory. What does it mean? Let's say there is a holding company. Under the holding company, there are two subsidiaries, subsidiary 1 and subsidiary 2, right? As of 31st March 2019, this structure exists. But in 2019-20, what happened? Subsidiary 1 has been merged into subsidiary 2, right? So prior to merger, holding company remains the holding of subsidiary 1 and 2. And after the merger, holding company remains the holding company of the merged company, right? So it will become a case of common control transaction where the transaction of the business, where the transfer of the business is happening within a same group. That means ultimate control before and after the transaction will remain the same. Ultimate control, that means in this example, ultimate control of the holding company before and after the combination will remain same with the holding company. Then it becomes a common control transaction, right? Standard also says a group of individual can be a controlling party if they are acting together. It may possible couple of people, 20, 30, 40, 30%. No one is having a control, but they are operating jointly. They are operating jointly under a contractual arrangement. Then those group of individual can be a controlling party, right? We will understand by having a couple of case study on these points. And the standard provides how to account for the common control transaction. It says I need to use the pooling of interest method, right? What is pooling of interest method? We have read pooling of interest method under AS 14. AS 14 says pooling of interest method means I need to recognize all assets and liabilities which I'm acquiring as a part of business combination at book value, right? Same concept have been carried forward under Ind AS 103 on account of pooling of interest method. It says assets and liabilities of the combining entities are reflected at the carrying amount. That means whatever the assets or liabilities the another company is acquiring, it will be recognized at carrying value, not at the fair value. So that means you can also say common control transaction is an exception to the fair value concept, because under common control we need to recognize at fair value. No adjustment are made to reflect the fair value concept. Only adjustment are made in order to recognize the accounting policy, right? This is the first point. Then I am coming to third point. I am skipping second point. I will come back to second point. Identity of the reserve. Standard says that I need to maintain the identity. I need to preserve the identity. Identity means if a query company has given the different reserve, capital reserve, security premium reserve, debenture redemption reserve. So I need to maintain the identity of those reserves when I'm combining that entity into my books. I need to maintain those reserves in my books of accounts. And fourth point is recognition of the capital reserve. So the difference in the purchase method, we have said purchase consideration minus net asset acquired is recognized as a goodwill. Here we are saying purchase consideration minus net asset acquired at book value will be recognized at capital reserve always. There will be no goodwill. Whether the number will coming to positive or negative, we will not recognize any goodwill. Only a capital reserve needs to be recognized. So it may possible the capital reserve will become a negative. It may also possible capital reserves will be recognized as a negative number in the books of accounts. So this is the accounting treatment which the company has to do under the pooling of interest method, right? One more point, second point. What is the second point is saying? Restatement of the financial statement. It is a very, very important point here. Financial statement in respect of the prior period should be restated as if the combination has occurred from the beginning of the preceding period. Let's say in 2010, the structure of a company is like that: holding company, and below that holding company, there are two subsidiaries, subsidiary 1 and subsidiary 2. It exists as on 1st April 10. Company has adopted Ind AS in 2020. That means company has to report 2020 as the first Ind AS financial statement. That means transition date is 1st April 2018 will be the transition date. Correct? Now, what has happened in 1920 till 31st March 2019, the company was preparing Indian GAAP and get their financial audited from the auditor under Indian GAAP only. Now Ind AS has come into the picture. The company has to adopt Ind AS from 1st April 18. Correct? And in 2019-20, what has happened? Subsidiary 1 merges into the subsidiary 2. Now, from the common control perspective, before the combination, before the merger, holding company was controlling both the companies, and after the merger, holding company is still controlling the merged entity. So that means it is a common control transaction, right? It is a common control transaction. And it happened, let's say, on 30th June 2019. Now I'm preparing financial statement for 31st March 2020, in which I need to give the financial statement 31st March 19, and I need to give the opening balance sheet as on 1st April 18 under Ind AS. And this transaction happened as on 30th June 2019. Now read this paragraph, second paragraph. Financial statement in respect of the prior period should be restated as if the combination has occurred from the beginning of the preceding period, irrespective of the actual date of combination. What does it mean? It's saying irrespective of the combination which you have done, it is only talking about common control, right? It is not talking about purchase method. It's saying irrespective of the combination you have done, irrespective of the date on which the combination you have done, irrespective of that, you have to restate your previous period. That means I will not account for this merger accounting from 30th June 2019. I need to apply this merger accounting from 1st April 2018. Financial statement in respect to the prior period should be restated as if the combination has occurred from the beginning of the preceding period, right? Irrespective of the actual date of combination. It means I will not account for the combination or the merger from the date when it actually happened. I will account for the date when, from the date of the beginning of the preceding period. Preceding period is 31st March 19. And what is the beginning date? 1st April 18 is the beginning date in that case. So I will account for from 1st April 18 and not 30th June 2019. This will result into certain complications. What happens to the losses? What happens to the tax return? Right? So it depends upon the company. Ideally they have to ideally they have to revise their tax return and all those stuff, but from the accounting perspective, they have to restate their previous year numbers and take the impact from 1st April 18 and not from 30th June 2019. So Mr. Quatra has asked, so a third column is showing opening values of the preceding period would be required to be disclosed with the changes in the opening values. Absolutely, sir. Absolutely. If you look at Ind AS 1, so in case of the first time adoption, the company has to give the three balance sheet: 31st March 2020, 31st March 2018, 19, and 1st April 2018. So these three balance sheet will have to be given in the first Ind AS financial statement. Someone asked, Mr. Rajiv has asked, what will happen to tax return? They have to revise it. They have to revise it. The tax return of the merged entity needs to be revised, right? So there are certain peculiar issues in respect of this accounting, right? Okay. So apart from the tax and all those stuff, let's focus on the accounting perspective. So I hope the first sentence of the second paragraph will be clear to you. There is one more sentence given in this paragraph, which is starting in the from the word however. However, if the business combination has occurred after that date, the prior period information shall be restated from that date only. What does it mean? It is saying that in the first sentence, what we are saying, where the control, where the common control of the holding company existed prior to 1st April 2018. In our earlier example, the control existed from 1st April 2010 only. If I change my example and I'm saying that the holding subsidiary 1 and subsidiary 2 relationship come into the picture only on 1st April 2019 itself, right? Then and the combination has occurred or the merger has occurred on 30th June 2019. Then I am not supposed to restate from 1st April 18. Then I need to restate from 1st April 2019. That means in the first example, if the control has occurred prior to the opening of the comparative period, then I need to restate the opening numbers of the comparative period. If the control has been acquired after the opening period, then I need to restate from that date itself. So Mr. Ravindra has asked one question. When all the assets and liabilities are carried at the same values, then what change are to be restated? When earlier both were consolidated, but later only one entity is consolidated. So changed in respect of, so the first point is the one entity ceased to exist. Now it becomes a merge entity, right? So from the consolidation perspective, it will not impact, right? But what will happen? The first and the second entity who has acquired the company, that company has to recognize the capital reserve and apply the pooling of interest method accounting. And when they will go for the consolidation, then this accounting will get reversed. That means I will reverse the common control accounting in the consolidation, because consolidation, it will not impact. Earlier I am consolidating both the entities, now I'm consolidating a single entity which is including the other entity as well. So someone has raised a point. Can you explain why the tax return needs to be revised? So sir, that is why I've said there are certain peculiar issues. There is no clear-cut guidance whether the tax return needs to be revised or not. But I am not a tax expert. But what I've heard, that it is an option available to the company, and largely for those companies who have actually done this accounting, they have revised their tax return in order to claim the losses lying in the other entities, in order to netting off certain things. So there are multiple issues. This is not a peculiar. This is very peculiar actually. So in the practical sense, companies have actually revised their tax return. Okay, I will take a couple of practical case studies in respect of common control transaction. A Limited, B Limited, C Limited. A Limited is holding 50% in the B Limited and 100% in the C Limited. And B Limited again holds 65% D Limited and 80% in the E Limited. E Limited merged with D Limited in the current year. Whether this transaction is a common control transaction. So what is a common control transaction? Before and after the merger, the ultimate controlling party remains the same. If before the merger, A is the ultimate controlling party, and after the merger, A will remain the controlling party, then I will say it is a case of common control transaction, right? So what is the answer? Transfer of subsidiaries within the group. Entity E is the ultimately controlled by A Limited before and after the transaction. So this is a case of common control transaction, right? Let's take another case study. B, C, D are operating contractually and they are holding 75% in ABC. A is holding 25%, right? So that means B, C, D are the holders. They are having a control, right? And BCD are also holding 75% in company XYZ. AE is holding 25%. That means BCD are holding 75% in ABC as well as XYZ. Whether ABC Limited and XYZ Limited are under common control transaction. Suppose tomorrow ABC Limited transfer one company or transfer one business to company XYZ. Whether the transfer will be accounted as a part of common control transaction. Answer is yes. In the above case, both ABC Limited and XYZ Limited are jointly controlled by the group of individual as a result of the contractual arrangement. Accordingly, ABC and XYZ are considered to be under common control transaction. Right? So this is on account of common control transaction. Now we need to understand what is the relationship between Ind AS 101 and Ind AS 103. My suggestion is, if you're reading any standard, you should also read Ind AS 101 along with that standard, because as I said initially, every standard under Ind AS is applicable retrospectively, and Ind AS 101 comes into the picture and provides certain relief and provides certain exemption. So Ind AS 103, we have said that the business combination needs to be accounted at fair value and it is applicable retrospectively. But Ind AS 101 comes into the picture, and Ind AS 101 says that restating or past business combination according to Ind AS 103. I think this is wrongly written. It is Ind AS 103. Restating all business combination starting from a pre-transition date, not restating a business combination that occurred before the date of transition. So what Ind AS 101 is saying? I gave you an example initially that if I have acquired a combination in 2010 and I am preparing my India's financial statement as on 1st April 2018, right? Do I need to apply the business combination principle for those combination which I have done in 2010, which I have done in 2011? Answer is yes, I need to apply. But that results in a difficulty for the company, right? Due to which certain guidance have been or certain exemption have been incorporated under Ind AS 101. Ind AS 101 provides us three exemption within the business combination. It says it is an option to the company whether to restate all the business combination. Restate means it is an option to the company whether to apply the business combination accounting to all the combination which the company has done in the past, right? Second, it says do not apply business combination, do not apply the retrospective restatement to any business combination which is done by the company in the past. So one is apply the provision of Ind AS 103 from the retrospective date. Second is do not restate, do not apply Ind AS 103 retrospectively. Third thing, it's saying that it is available at the management level that they can evaluate a particular date or they can identify a particular date that the business combination to be restated from a particular date itself. For example, if I'm saying I have done multiple combination each year, I am doing since 2010 2018, I am doing the multiple combination every year basis, right? But I want to restate only for those combination which I have acquired from 2015. So as a management, I have an option under Ind AS 101 that I can select 1st April 2015 will be the date from which I will apply the business combination principle, and on all business combination which I've acquired from 2015 2018, I need to apply business combination principle to those all acquisitions which I've done. So I just need to summarize what is the exemption. One, restate all the business combination means apply Ind AS 103 retrospectively. Do not restate business combination, that means do not apply Ind AS 103 retrospectively, apply prospectively. Third, select a date from which you want to restate. If the management select 1st April 2015, that date means after that date all the combination which I have acquired by the management has to apply Ind AS 103 on all those combination. That means all the assets and liabilities which have been acquired in during those combination, management has to do fair valuation concept. That is the interrelationship between Ind AS 101 and Ind AS 103. One more, PP exemption versus business combination exemption. So PP exemption, suppose I'm transiting, I am preparing my first Ind AS financial statement with the transition date 1st April 2018. Under Ind AS 101, there is a guidance that whatever the PP existing as of 31st March 2018, I can adopt the carrying value exemption and recognize those carrying value as per Indian GAAP as of 31st March 2018 into my Ind AS accounts as on 1st April 2018, right? That is an option given under Ind AS 101, right? So one side I have taken a carrying value exemption, and standard also says that if the carrying value exemption has been taken, I need to apply the carrying value exemption to all the asset. I cannot do the cherry picking. I cannot do the case to case basis that for particular item I'm taking fair value and for particular item I'm taking carrying value. If the carrying value exemption has been taken, then it will be taken for all the assets. So this is the one part of Ind AS 101. Now the other part is, let's say the company has adopted the PP exemption as on 1st April 2018. Now the second side, if the company wants to do apply Ind AS 103 retrospectively from 2010, right? So it may also possible there are certain PP, land, building, other plant and machinery which the company has acquired as a part of business combination which are existing as on 1st April 2018. So as a part of the business combination, I need to fair value all those assets and liabilities. But as a part of the PP exemption, it is saying those all the PP which is existing as of 31st March 2018, I need to adopt carrying value. I cannot do the fair value. So these two exemption results in a contradiction to each other, because business combination exemption is saying I need to do the fair valuation, and PP exemption is saying you have to record at carrying value and no fair valuation is allowed. So what will happen? So three scenario came into the picture: whether the business combination exemption override PP exemption, whether the PP exemption override the business combination exemption, or whether the both will be applied to a partial extent. So then ICA has clarified this query through the study material, and they have said that the assets which I have acquired through the business combination, those assets needs to be fair valued, and apart from those assets, apart from the business combination PPE, the assets needs to be recognized at carrying value, right? That means those assets which have acquired through business combination needs to be fair valued on the transition date, and the other assets which have not acquired through business combination will be recognized at carrying value. So these are the two interpretation or the two coordination or the interplay between the business combination exemption and the PP exemption. Business combination exemption, if I summarize, either to restate, don't restate, or restate from a particular date, right? Now I'm moving ahead. We have left with the last concept, differences. Ind AS versus Indian GAAP. What is the difference between the Indian GAAP versus Ind AS? Scope. AS14 only talks about amalgamation. AS14 does not cover the acquisition and other related stuff. While Ind AS 103 is a very comprehensive standard and it includes merger, demerger, acquisition, all those stuff. Acquisition date. Under Indian GAAP, we need to account for from the appointed date. What is the appointed date? The date which have been agreed between both the parties. But under Ind AS, we need to account from the effective date, right? MCA circular issued in 2019. What it says, if approval from the court is required, then appointed date will become the effective date, right? Accounting for common control transaction, it does not exist under Indian GAAP, but guidance is given under Ind AS 103, and it says pooling of interest method accounting needs to be taken care of. Amortization of goodwill. So under Indian GAAP, there are various views. AS14 goodwill amortized over 5 years. AS10 goodwill amortized over the period of AS21, 23, 27 goodwill. It will be tested for impairment. But under NDS, goodwill amortization is prohibited. It will always be tested for impairment. Bargain purchase gain, under NDS we will say it capital reserve and recognized as a part of reserve and surplus. Under NDS we will say it will be recognized as a part of capital reserve, and we will name it like a bargain purchase gain, and it will be recognized in SOCI. From SOCI it will be taken to equity. Accounting for business combination, there are two types of method, merger and purchase. But under business combination, there are two methods. One is purchase method, second one is common control. Purchase method is also called the acquisition method, which is a fair value accounting, and common control is a within the subsidiary accounting, and it is at the book value. Right now, the final topic is difference between the IFRS and Ind AS. Common control, as I said earlier, common control is scoped out from IFRS 3, and from the Ind AS perspective, it is included in the scope of Ind AS 103. Accounting for bargain purchase under IFRS, it will be taken to income statement. Under Ind AS, it will be recognized in OCI. Transitional provision, there are certain transitional provision given under IFRS 3 only, but in India, we have included the transitional provision under Ind AS 101. Any doubt, guys? Any doubt? So this is about business combination. Any doubt? Any doubt, guys? So if I summarize the entire session, if I summarize the entire session, so there are three things. One is what is business? What is business combination? Second is the purchase method. Third one is the common control transaction. Right? What is business combination? Control. When the acquirer has obtained a control, control means more than 50%. Control, for control we need to evaluate 110 as well. What is business? Input, process, output is the business, right? What is business versus asset acquisition? Business combination versus asset acquisition, different accounting, significant different. Under business we need to compute goodwill. Under asset, goodwill is not to be computed. Entire value will be assigned to the value of the or the cost of the PPE, right? Transaction cost will be charged to P&L for the business combination. For asset acquisition, it will be capitalized as a part of PP, right? Then we have talked about purchase method or acquisition method. Within the acquisition method, we have talked about acquirer. Who is the acquirer? The person who is acquiring a control is the acquirer. The person who is discharging the purchase consideration is the acquirer. Then second step, we have talked about appointed date versus effective date. Under business combination, we need to do effective date accounting. MCA circular says where approval of the court is required, then appointed date will become the effective date. Then after that we have said how to compute goodwill. Very important. Purchase consideration. Purchase consideration needs to be fair valued. Purchase consideration also include contingent consideration. It also includes deferred consideration, right? Then we said net asset. Net asset needs to be computed or recognized at fair value only, right? Um, then we have said it may possible that the company may have the hidden intangible which needs to be identified and recognized at fair value. Then we have said what is the contingent liability. Contingent liability will be recognized at fair value, right, which is dependent upon the occurrence and the non-occurrence of future event. Then we have talked about indemnification asset which will be recognized at fair value only. Then we will say goodwill needs to be computed basis on this formula, or bargain purchase gain will be computed based on this formula. Then we have talked about step acquisition, one step ahead for control, from non-control to control. That means 40 to 60%. In that case, we need to fair value our previously held stake as well, right? Then we talked about loss of control and change of control. In case of loss of control, we need to do the reverse accounting of the business combination. That means de-recognize assets, de-recognize liability, de-recognize NCI, right? In case of change of control from, for example, 80 to 60%, it will be recognized as an equity transaction. Then we have talked about defer tax. Defer tax, if the goodwill is a tax deductible, then defer tax will be recognized. What will be the accounting? Goodwill debit to defer tax liability, or DTA debit, defer tax asset debit to capital reserve or goodwill, right? Then we have talked about purchase price allocation. Purchase price allocation needs to be done for all the business combination, right? Where we need to involve the valuer who will identify the fair valuation of all those assets and liabilities and the intangible assets as well. Then we have that is, this entire thing is a purchase method or the acquisition method. After that we have talked about common control transaction. Ultimate party, ultimate entity will, before and after the control will remain the, after and before and after the merger will remain the same. That is what the common control transaction. That means within the subsidiary, within the group, the transaction happening is a common control, right? What is the method? Pooling of interest method. Basis of accounting, pooling of interest method based on book value method, and the differential will be recognized as capital reserve. No goodwill needs to be recognized. This is the gist of entire business combination, IFRS 3 or Ind AS 103. So someone said there was some prohibition on the recognition of deferred tax on the initial recognition of goodwill on the business combination. So that will be covered as a part of the Ind AS 12. So certain initial recognition exemption has been given under Ind AS 12, right? So that will be covered as a part of the Ind AS 12 only. Any other doubt, guys? Any other doubt? So Mr. Ajay Kumar has asked one question: why are we doing the accounting at book value in case of pooling of interest method and not fair value? The objective is this is happening within the group. Suppose before the merger or before the transfer of the business, holding company holding company is consolidating both the companies, right? And after the merger, holding company is again consolidating the same companies but in the form of the merged companies. Just because of the change in the placement of the assets and liabilities, whether there is any change in the net worth of the company, answer is no. If I give you another example, let's say you have the 100 rupees in your one pocket, you have transferred 50 rupees from one pocket to another pocket. Is there any change in the net worth of the company? If there is any change in the net worth of yourself, answer is no. It's only a change in the placement of the assets and liabilities from one place to another. It is not impacting consolidation. That is why a book value method is taken care of in this common control accounting. So someone said the cost of acquisition are tax deductible over a period of 5 years under income tax. That should not change the goodwill, as this would create a temporary difference. So sir, that will not change a goodwill. That will not change a goodwill. It's only a temporary difference because under Indian GAAP or under Ind AS, you will charge it to P&L, and under tax, you will claim it over the period of 5 years. Then you will recognize the deferred tax through P&L, not through goodwill. Deferred tax needs to be computed on goodwill only due to the change in the fair valuation of assets and liabilities on the acquisition date. I hope this is clear. So one more thing, I have developed 10 questions, which is MCQ questions, right? And these MCQ questions I have covered during the part of my discussion in the entire 3 hour session. You can see this question and you can provide your answers in respect of this. Any other doubt? You can raise your question through the chat box. I'm not getting the proper voice. I'm not getting the proper voice. Who's speaking? Savita ma'am? I'm not getting the proper voice, ma'am. So someone has, Mr. Quatra has raised the question. Any example of intangible that should not be recognized initially? Sir, for example, the customer list, the contract or the customer list, I will not be recognized as a part of intangible as per Ind AS 38 or as per AS 26. That will be recognized as a part of the business combination. So Mr. Ajay Prasad has asked one question. So just a second, just a second. Uh, So one manufacturing unit of company A purchased by company B on a going concern. How should this transaction? Sir, now you are a champion in India's 103. So this is if you have to evaluate whether it's a business or not, right? And if it is a business and it is not a common control transaction, then you have to apply the principle of purchase method or the acquisition method. So Miss Miral has raised one point, sir. In learning the standard, one important concept is control, and I also learned that you have great control on the standards. Okay, it's fine. Okay, Mr. Vidhi Chandak has said that I have typed 5 times. Sir, what is that query? Let me see where is the queries regarding one query which I posted regarding the acquisition through IBC. Okay, I've got your query. I'm just reading your query. Suppose A Limited has acquired B Limited through IBC and B Limited has land. As per RP, its asset has to be accounted at fair value. Okay, so in books of B, we need to account in fair value on the date of acquisition, but then in CFS, IT has to be taken at asset acquisition and divide the consideration proportion of book value. What will be the book value in that case? Regarding one query which I posted regarding the acquisition through IBC. Sir, I'm reading again. I am not able to understand your query. Suppose A Limited has acquired B Limited through IBC and B Limited has only land. Okay, A is acquiring B and B is only having land. As per the RP, what is RP? Registered professional kind of thing. What is RP? Resolution plan. Okay. As per RP, its asset has to be accounted for at fair value. So in books of B Limited, we need to account in fair value. Okay. So you are saying as per RP, in the books of the B Limited, company has to account for at fair value on the date of acquisition. But then in CFS, IT has to taken, what is IT? Income tax? Acha. But in CFS, it has to be taken as asset acquisition and divide the consideration in the proportion of book value. So how many assets you are having in that company? So let's say there are more than one asset. Let's say there are 5 assets. Okay. Okay, 2 land and 1 office. So first of all, this is not a business combination. This is an asset acquisition, right? Let's say you have paid 1,000 rupees. Let's say you have paid 1,000 rupees in order to acquire those assets, right? and you are saying in the books of the B Limited, it is already appearing at fair value, then in that case, fair value will become the value which at which you will recognize in the console books. Then there will be no book value. The amount which you have paid 1,000 rupees, that needs to be apportioned in the two land and one office on the basis of the fair value of that, on the basis of the numbers which are appearing in the books of B Limited. I hope this is the answer to your question. Okay. Any other doubt, guys? I just need to check. Have you actually enjoyed this 3 hour session on the business combination? I've tried my level best to simplify the concept from your perspective. It's actually difficult to communicate everything through verbal communication. So I'm getting the good response from the people. So if there is no other query, so someone said it's a very interesting session but too heavy. So I agree. Business combination is a big standard. So there are a couple of standards which are slightly big. For example, financial instrument. For example, consolidation, and for example, business combination. But factually speaking, I have tried my level best to make it simpler for you guys' perspective, so that we can communicate through wordings instead of writing over the board, and I can explain you in a better sense. So couple of people are saying asking for my phone number and the email ID. So I have already typed my email ID and email ID and the phone number. I will again type it. So I live in Gurgaon, sir. So Savita ma'am, can we wind up this session?
Yes, sir. Yes, sir.
Okay. Okay. Thank you, ma'am. Thank you, all
Thank
of
you.
you
Thank
guys.
you, sir.
Thank you for your patience.